So in the aftermath of the US election, there's so many things going on, but the thing I want to focus on is the dollar. It's something that I've been concentrating on for a while, and I think some of the dynamics have changed seriously and very importantly. If you remember, the dollar's been trending higher for an extended period of time now. Much of it was driven originally by some of the change in central bank policy as the BOJ were easing and the Fed were looking at tightening. And that kind of moved in and sucked in market participants, and parts of the carry trade got caught in, emerging markets got caught out, and the oil price fell with it. After that phase, which finished in January this year, things have been very stable in the dollar since. But then as soon as the election result came, things turned around dramatically and the dollar has been on an absolute tear. We've now broken the chart patterns. If you look at the chart of the DXY, you can see it's now broken that consolidation pattern and is now headed much higher. So this is now the next phase, and I think the accelerated phase of the trend higher in the dollar. We also have the same kind of breaks going on in the euro, which broke a consolidation pattern and is about to break a larger pattern here. And also things like dollar yen have started moving as well, finally in the direction that I've been hoping for some time, which is to see the dollar rising against the yen. The RMB has also been falling dramatically against the dollar, and all around the world currencies started shifting. The Asian currency index of ADXY, that's also starting to fall dramatically against the dollar. So what happened in the election that's changed things? Well, part of it was nothing's changed in the fact that that trend was there and we were kind of waiting for the next catalyst to bring it along. But the catalyst of Trump being elected was something that people don't really perceive why. Firstly, they look at rates and realize that rates backed up very sharply. And I think Julian Brigden's going to be talking about rates in this US election special. But that backup in rates obviously makes the US dollar more attractive. So US rates are much higher. It's a high yielding bond now versus virtually any other major currency. So that's an important thing. So that started to get people and traders involved. But there's a bigger picture backdrop, which is based on the election, which is the fact that Trump's policies are very clearly protectionist. This is one of the things I think he will likely try and push through, whether it's the breakup of TPP or some renegotiation of other trade deals. Now, the point being is the world is dollar starved. And if there's a shortage of offshore dollar funding, the Eurodollar market, and Trump starts protectionist policies, it means less dollars flow into the global system because they're doing less trade with the US. And that means there's just not enough dollars to go around for all those people who borrowed dollars. And so that in itself is an extremely positive outcome for the dollar, and something I don't think Trump realizes, because he's imagining that the protectionist policies will help US industry, but the problem is US earnings are going to fall because of it. In addition, exports are going to fall and imports will rise, which is kind of the opposite of what he was trying to do. But let's see how that plays out over time. And I'm not here to pass judgment on his policies. I'm here to talk about the market impacts of these things. So the dollar is rising because there's a perceived lack of dollars in the outside system. And we've seen this in the LIBOR market, which is the London Bank interbank offered rate. And that's been rising along with the risk of US interest rates rising. But the other reason it's been rising is because monies keep getting taken out of that offshore funding market and being put onshore in the US. So for example, the money market fund change recently meant that money market funds who put their money in that Eurodollar market into the kind of secondary markets have now gone and put it in the Fed funds market. So that's taken about $1 trillion or so out of the traditional money markets. Okay, so that becomes concerning when you look at what the BIS have been talking about, which is this $10 trillion shortfall of dollars out there where people have borrowed dollars, and as the dollar rises, they're scrambling to pay it back or secure new funding, but the funding costs are going up as well. So it's creating a real problem for people having to pile into dollars. Now, as the dollar starts to accelerate on these twin changes that have gone on, i.e. interest rate rise and the trade policies, it's going to suck in more people into that position where they're going to have to decide what to do with their shortage of dollars. Because don't forget, they've all borrowed dollars. And that Eurodollar market is them essentially borrowing dollars from the European banking system, the Japanese banking system, and elsewhere outside of the US banking system. And that's where there aren't enough dollars around. The other thing that's happened is, or is likely to happen, is there's going to be some sort of repatriation of corporate profits. Both Clinton was talking about this and Trump was. And I think they'll do it. I think it was Bush originally did it. way back in the early 2000s. It was the Homeland Investment Act at the time. And the idea there is that corporations can bring back all of those profits, all that money they've hoarded offshore, bring into the US for a small tax penalty, and then that money can be implemented either in infrastructure or whatever other policies the governments are trying to do. Now, what's interesting there is you're bringing, obviously, if companies have holdings in foreign currencies, euros, whatever, they will sell those euros, buy dollars, bring them back, pay the small tax. So that automatically pushes the dollar up yet again. But the more important factor is not those guys with the foreign currencies, because most US corporations don't want to hold too much foreign currency because their earnings are in dollars and they're reporting dollars. It's people like Apple. They have hundreds of billions of dollars in US dollars cash, but in the European banking system. So what do they do with that? Well, they start to take it to the US banking system, and that again takes hundreds of billions of dollars out of that Eurodollar market. So there's more sucking out of that market, and all of these borrowers are going to be scrambling to find funding. It means that the Fed are going to end up having to extend swap lines all over the world to allow some dollar liquidity, but rates are going to go higher for this. It's going to get harder to borrow money, and that means that people are going to have to buy more and more dollars over time. Now, the thing about currencies is they trend for extended periods, and it's something I've talked about in Real Vision quite over the last 2 years now, is that the dollar has only moved up about 30% in this entire bull market. That's against 50% back in the late 90s and 100% in the early 80s. My target has always been that this bull market is going to be a very big one. And that's probably going to mean it's somewhere between 50% and 100%. So I think the rise from here is at least another 30%. Now, there are also knock-on ramifications for all of this. China, as you can see, is devaluing its currency rather rapidly. But we're going to find that currencies are going to start falling sharply. We're going to expose weak currencies. We've seen it in Egypt already. I think Turkey is going to get itself in a mess, and that's going to spread around the emerging markets. But also in that kind of protectionist world, countries like Korea and all the big exporting nations of Asia are going to get caught in the crosswinds. And, you know, I've been bearish on Korea for some time. It's not been the best bet. It worked last year, didn't work this year. But I think Korea and other countries like that, Taiwan, are going to struggle in this environment. They're going to struggle if the yen is weakening, which it is now. They're going to struggle if the RMB is weakening, and they're going to have to weaken their currencies themselves. And that's probably going to mean weaker stock markets as well, because global dollar earnings are going to fall. And we saw that there was a big feature of this year and last year is world trade is shrinking. So the globalization element of the world is definitely reversing, and the world is becoming slightly more insular. And that again means less world trade, less dollars in the system, and that makes it very complicated. So I think for me, the key thing from this Trump victory to focus on in markets is the dollar. I think it's a relatively easy, clean trade. It's moved very sharply recently, so I think the chance of a correction going into year end as people square up their books is relatively high. But at that point, I think 2017 is going to be another shockingly strong year for the dollar, and that will have macro implications beyond that. The law of unintended consequences will suggest that it's going to knock onto the US economy and the global economy overall. The overall bullishness in, for example, in oil prices is likely to be misguided. And I think we need to be very cautious about how 2017 plays out.
And our currency of the week is dollar yen. Dollar yen, a very popular pair for institutional traders, less for retail traders. So the Bank of Japan can be happy. This is Governor Kuroda with his happy face. Dollar yen is on much higher ground. A weaker yen means more competitive Japan in exports, competitive against the big rival China, because the yuan has weakened, but the yen has weakened much more. So if we compare the yuan with the yen, it's much more favorable for Japan, and it pushes inflation a bit higher. So there's no need for helicopter money from the Bank of Japan to monetize government debt. And also the Bank of Japan that announced a new policy in September had a chance to implement it thanks to Donald Trump, thanks to falling bond yields. They intervened in markets, and it's not only talk, they actually stabilized 10-year bonds at 0%. That's their new policy. That's the good news. Now, the bad news comes from, here's Bank of Japan can be unhappy, and unhappy Kuroda, because inflation is still too low, not going anywhere fast. TPP, it's more a government issue. The Trans-Pacific Trade Agreement is mostly dead. Donald Trump, well, it had a lot of opposition also beforehand, and Trump, that's one of his more clear messages. He does not, all his messages are clear, does not want to enact it, to sign it. So it's mostly dead without the United States. And government reform is still slow. That doesn't help inflation too much, okay? Now, in 2017, if we look forward with our currency of the week, dollar yen depends most importantly on the US dollar and on Donald Trump. Why? Because in Japan, there's limited scope for further action from the Bank of Japan. Okay, there's also limited scope. Why is there limited scope for action from the Bank of Japan? Because they already made their big policy move in September, and they usually wait quite a long time for it, for the results to show up. There's also limited scope for significant government action, because, well, without a trade agreement, and we haven't seen too much. So what matters more is the policy coming from the US, from the government, from Trump on trade. That makes, of course, a big difference for Japan. And, of course, fiscal stimulus, the same policy from, also policy from Trump, that impacts, of course, the Federal Reserve and the next moves, the next rate hikes. So for at least for the beginning of 2017, it's all about the dollar and the Donald for dollar yen. That could be the best proxy for the US dollar, because in the Eurozone, we have elections, we have lots of other stuff. In the UK, we have Brexit. You name it. The Canadian dollar moves on oil, but Japan, I think, will be more quiet, and it'll be much more dependent on the Donald and on the dollar. Okay.
All right, guys. A very good morning, good evening, good afternoon. Navin Prithyani here from urbanforex.com. Now, before we begin, just wanted to say hello to all of you guys here. Those in the chat room, can you guys give me some yeses so I know who we're working with here? And also, if you guys can let me know where are you guys from? Can everyone hear me just fine, first of all? Is the audio okay for everyone? Yeah? Okay, good. Okay, let me get the screen sharing up and running. Okay. All right. Hello. Okay, so let's get started here. Now, the topic for today is forecast for 2017. Let me turn off the camera here. Okay. The forecast for today is the topic for today is forecast for 2017. So we're going to be working with the higher time frames here to get an idea of what to expect in the upcoming year. So what I'm going to be doing is I'm not going to go into okay, the sound is breaking. It should get okay automatically. Is it okay? Let me know if you need me to repeat something. I can. But I'll keep going otherwise, unless you guys let me know, okay? So I'm going to be working with the daily time frames. I'm not going to go into a much higher time frame because I'm not going to give a full outlook until the end of 2017, but up until mid-year 2017. So that way, and I'll do another webinar with FX Street around mid-year to show you the projections for the rest of the year, okay? Hi, Chris. How are you? So what we're gonna do is we're gonna start with forecasting into early next year, going all the way up to June, July-ish. Okay. So let's start with some of the major pairs. What are the pairs you guys want to know some forecasts for? We're gonna start with Euro USD, but if there's anything particular you guys want to see, you guys can let me know. Okay. We'll start with Euro USD, and then as I see any other requests, we'll bring them in. Okay, so here we go. Euro USD for the entire last year so far, the year of 2016. We saw not much movement, as you can see. Let me pop up to the weekly to just give you a quick overview. Okay, so the whole of 2016, we've been working with this range here. Okay, we started off strong. For Euro going higher, and then we pretty much ended back to square one. Okay, hello from Austin. Okay, I see a comment from YouTube from Anthony. Hello. Okay, so let's, when we're looking at stuff like this, after the elections, the market started to move a bit. Euro USD became a lot more active, so that's pretty interesting. Let's go back to the daily, and when we look at stuff like this now, we're seeing a massive drop coming in from the markets. The momentum keeps going lower, and as the markets keep going lower and lower, okay, projecting this into 2017 here, we're still working on shorts. Okay, charts are lagging. Okay. I'm gonna keep going. I think the lag will fix itself. Sometimes there's a slight lag on Google, but it'll be okay. And I'll pace myself so the chart goes with the words. Okay, so for the most part on this, we're at the bottom of the range. However, we are looking like we're trying to cross the bottom of the range. Notice the momentum of this. It starts off weak. Okay, the drop happens. I'm gonna draw it for you guys. The drop happens from here to here. Then it pulls back quite aggressively during the election times, and then it drops quite heavy. Okay, as it drops quite heavy, it picks up momentum, pulls back only 50%, and the drop is now resuming again. So we're looking for a further drop to happen. Okay, so still expecting shorts on this, which is a stronger US dollar. Now, expect some turbulence. Okay, the world is expecting turbulence because Trump is in the house, blah blah blah. So that's sort of expected in the news. But remember, the more the news is there's havoc in the news or haywire in the news. If I was to put it in a simple terms, that's good for business, because as traders we need a little bit of momentum going in the market, right? So as we get movements and momentum going into the market, we have a little bit more stability in direction. Okay? So crazy news is good for us. Crazy news is good for us. All right. So that's Euro USD. Let's move into the next major pair. We'll go into Pound USD. Let's take a look at what Pound USD is doing. All right, Pound USD going into February. I'm expecting this area to hold. I don't expect this to be breached. Expecting this still to be short, and I look forward to seeing this to maybe pull back to a maximum here and then further drop at least down to here. So this is going into early February. Take a look at that to see beyond February. Yeah, we might even make lower lows after that. So we're still watching this area closely. Okay. Okay, actually, wait for a struggle here. There's going to be a struggle on this. Wait for a struggle to come up a little bit more. Okay. If you see a sudden spike up here that breaches this recent high, and then starts to roll around, that's the area where I would be more keen to look for a short, something right around there. Wait for that area to be breached, because the sell is so aggressive right now. I want those sellers to get taken out first. Okay, I want those sellers to get taken out and start thinking of longs, and as they start thinking of longs, that's when the sell is ideal. Okay, so Pound USD looking for a short, but still not yet. I am on standby when it comes to that short. Okay, so just wait for it. Wait for the New Year's to create something crazy in January. Let the price rise up a little bit and say the dollar is weak, and then going into February or so, we'll go for a dollar strength after that. So let's see what Trump's going to do in early January. Okay, Euro Pound next week or a month. Yeah, let's take a look at that. Euro Pound as well, and then we'll go into Japanese Yen pairs as well. That's another request we have. So Euro Pound. Okay, here we go. Euro Pound. Okay, for next week, this thing is still showing short. Yeah, let it come up a little bit more, but this thing is still showing a short when it comes to further outlook going down the line. We got a temporarily long coming up. Because we're at the bottom of this range right now. So expect a pullback into this massive seller that's just come in. Okay, so moving forward. Okay. All right, so we got some so for next week for Euro Pound, we got a short coming up. However, we're at an extreme dangerous support area, a major support area. So any sells are in its last stages. Look at the previous sell, how it reacted. He came down a little bit aggressive, but then it bounced right back up. So it's got momentum as people are preparing for longs. It's got momentum to still spike down one more time. That's why I'm still saying I'm still keen to see a sell come in before the long can happen. So to take out all the stop losses that are below this guy. Okay, so that will be an interesting spot to see. Okay, let's take a look at some of the yen pairs. Let's open it up. Let's look at some strength. Japanese yen pairs. Okay. First things first, let me go into our strength chart from Forex Watchers. Let's see what we have going on for the strength numbers. Okay. Okay. We got yen across, weak across the board. Let's take a look at that carefully. Okay. Let me clean this up for you. Okay, move this up to a daily. All right, here we go. Okay. We're going to start with USD yen. Okay, yen is weak across the board. So that's like, wow, it's extremely, extremely weak. Let's take a look at this on a higher time frame, see what's going on here. What's the picture here? Okay, so further weakness for yen into 2017. I don't see any corrections coming in anytime soon. Further weakness. Yeah, further weakness. So actually going into 2017 and even 18, we're looking at something like this. Okay, so we're going to be in this price range. Into 2017 and 18. That's a very, very big picture. But going into the daily charts and weekly charts, do expect some volatility coming in around this area. But still, I would say weakness for yen is ideal. Still go for the weakness for yen. So any pullbacks coming in, I would expect the pullbacks to come in a little bit as deep as possible. So give it maybe January, February to give you a nice little pullbacks coming in, and then re-prepare for longs. Okay, that's USD yen. Let's take a look at CAD yen. Let's see what CAD yen has in store. Higher time frame, similar concept. This one, on the other hand, is showing going into 2017 and 18, this thing is going to be for yen strength. Yeah, this is going to be for yen strength. However, temporarily it is for yen weakness. So same thing here. Wait for a pullback. This one might even give you a decent pullback. It might even push in a little bit deeper. So a pullback into 8,400-ish or so might be ideal. Can get as low as 8,200, and then prepare for longs again. Okay, don't expect higher high sequences. It's not going to happen. All right, going further, let's take a look at pound yen. See what pound yen is. Pound yen is even stronger when it comes down to saying yen is going to get strong. Yen is going to get strong going into mid 2017 to 18. Now, as we discuss these things, I want to ask a simple question to you guys. Why is forecasting currencies important? Okay, why is it important? Okay, while we go into this, I'm going to do this currency pair while you guys think of that question or answer your questions. And before we continue to the next pair, I'm going to help answer that question. All right. So, all right, pound yen, here we go. So we're looking at 2017 to continue to go long in early 2017 and late 2017. Look for Japanese yen strength. So early 2017, some strength will kick in. And then we're going to expect some weakness back again. And as we do that up until mid-July, going into October, look for further Japanese yen strength. Okay, so around 1400-ish, more or less. What's the reason for USD yen for further weakness? Can you briefly give your reason for it? I'm doing this basically on technicals, looking at the overall flow of things, and markets always have temporary corrections. With the temporary corrections, notice because of the speed that things are coming in, the general population tends to only focus on this and they forget about all of this. Okay? So what happens is while they focus on the short term does not say it's wrong. It is correct. However, as people get caught up into the short term, what happens is the underlying big boy is just waiting. Okay? It's like a sleeping giant. He kicks in every now and then. And when he kicks in every now and then, he hits the market hard. So whenever I see a strong counter move coming in, it actually makes me get more excited because I see a bigger move coming in. Now, can everyone see this strong counter move come in right here? Okay, when you see a strong counter move come in like that, people start preparing for longs, saying that these shorts are over. And as they start preparing for longs, the higher the price comes up, the more aggressive the sellers prepare for selling. Okay, because people become biased. So as people become biased, again, it's good for business. It's good for business because that's how the 95-5 works. You want majority of the people thinking one way. Now, if I was to say at this very moment, give me an opinion on pound USD based on this, on pound yen based on this chart, I'm going to get answers that's going to say, some is going to say long, some is going to say short. Here's the one thing I want to ask you guys. At what point does everyone's answer line up? Okay, so if those of you who are saying at the moment of sudden movements or who was thinking that is correct. It only happens when there's a news event happening, and then when people are thinking something about the news event and the news event propels the market in a certain way, one, it sets in fear for people who are thinking the opposite, and two, who are thinking in that same direction, and now that they got a confirmation, they are now loading up for their positions at a much later price. So no one is buying down here, but everyone's buying up here. Okay? And those who are panicking, whoever was in a sell thinking this cannot happen, is also exiting their positions up here. Exiting their sell positions up there. So everyone is making a bad decision with emotions. Okay? That's when all the people line up into the 95%. That's the moment where everyone's bias becomes one. Okay? So when you line up the aggressiveness to conservativeness to fear and greed all together at one spot, it happens when the market suddenly moves. Okay? And that's when things line up for the big boys who are a little bit more patient, and they just hit it. And then it ends up into the hands of the 5%. Okay, does that make sense? Does that make sense? Okay, so moving on forward. Now, the question I asked regarding why is it important to forecast this? Now, currencies, not only do they play an important role in forecasting and turning a profit from trading, but it can also help you in understanding of, okay, if you're going to be buying a house, you can even buy houses in offshore countries. You know, you don't have to buy a house in your own country and always go into, investing into something in US dollars all the time. Or, having that said, you can also time it on when you can buy it, when you can sell it, and get that additional 10-20% from the currency exchange as well. Okay? It helps also with negotiating. Okay? If you guys follow how I travel around the world, it's not random. I follow the markets and I travel accordingly. I go wherever my money has the most value. And then I go in and I negotiate hard and I make sure I sign contracts for years on ahead of time, saying instead of 1 year contracts, I can take in up to 3 years contract and I can lock in the price at the low rate. So forecasting can be a very good weapon. Okay, does that make sense? So you can use it in all walks of life, whether traveling for vacation, whether investing for properties, or whether learning how to negotiate when it comes to, big deal purchases and locking in the price before a movement happens. Okay? All right, so moving forward. All right, let's go take a look at the other yen pairs. We got pound yen. Let's take a look at Aussie yen. Aussie yen. Aussie yen, one of the weakest when it comes to, as we're saying, going into 2017, 2018, all the yens are going to get strong. Not for Aussie yen. Aussie yen would be the worst one to say it would be going for a strong, because Aussie is also a bit strong. Okay, so having that said, so this is the area where we're looking at the next zone here. This was the zone, but it's been breached. So this level is no longer holding. The next level's up here. So I would in fact go more with longs on this one. However, having yen being weak and then strong going into next year, and this one not agreeing with that, I would say Aussie yen is a pair not to be messed with. Okay? We generally pair up a strong pair with a pair that does not have any strength, or a weak pair. But we don't pair up a strong pair versus a strong pair. Two strong economies does not make the price move anywhere. Okay? You'll end up in a ranging situation and lots of spikes. And that's the last thing you want. Okay? Alright, so Aussie yen. I'm gonna change the color for that. Okay, that one is out of the question. Moving on to New Zealand yen. Similar scenario. It is out for now. Let me go up a little bit. Let's take a look at this. Yeah. Now looking for strength on this one towards the end of 2017. Early 2017, still some weakness. However, I would not be interested in messing with this pair, because as longer-term forecast, there's a longer-term forecast requires holding, and this pair cannot be held onto. Cannot trade this to hold. Okay, so it's not a good investment. Euro yen. Let's open this one up. Okay, Euro yen's another good one. Looking at an area here. Yeah, Euro yen still healthy, and we're looking at some strength coming in for the month, the upcoming months. As the strengths come in for the upcoming months, expect some more weakness after that. And as the weakness comes in, we're gonna baseline for a bit, going into middle of the year. And then following that, expect a further decline towards the end of 2017. So this is going to be an interesting pair. So no long-term holding for this one, but rather be playing a range on this. Pick the bottoms on this and exit at whatever the high it plants. Do not go further than that. Okay, and then do not take shorts. Keep going for longs. Once the longs are over, towards the end of that, prepare for shorts after. Only when you start seeing weird spikes start to happen. Okay, then prepare for shorts. Okay. All right. Okay. And sorry, I don't know how to pronounce the name really well, but the question was, how is Aussie and yen both strong? Because we're expecting yen to be strong towards the end of 2017. And if Aussie is extremely strong across its board, and we can actually see the strength here on this chart, well, what's going to happen is if Aussie prevails as strong and yen starts to come in as strong across the board against its other pairs, then Aussie and yen itself are going to battle for the strength. Okay? So a strong pair and a strong pair does not move the market much. It's going to hover around in a certain spot. Okay, so when it hovers around a certain spot, anything else that doesn't do that will give you a smooth momentum, will give you a direction. But the pairs that are aggressive, like Aussie might be aggressive, and if yen is aggressive, what's going to happen is, if you have a long here, for example, notice this spike down here? That's going to stop out a lot of people. Okay? Anyone who's going to have a short from up here is going to get additional spikes as well. It's because both sides are powerful. If both sides are powerful, expect spikes. Does that make sense? Okay, look at this. Ranging market, which means both sides are equally strong. You get spikes in situations like that. Look at this range here. Look at these aggressive spikes popping out of the ranges. This happens quite a bit when there's equilibrium in the market, when it comes to one side is almost as strong as the other side. And they're very aggressive spikes. Okay, so it's almost like no matter where you put your stop loss, they're coming for you. Okay, so it's all, what we're doing right now is the basis of how trading should be started. You go out picking the right pair. Once you pick the right pair, then however you plan your strategy on trading it, it should be already a bit safer, because you're not picking a pair that you're gonna run into a problem anyways. Does that make sense? Okay, so let's take a look at some more pairs from the strength meter, see what else is showing up on the meter. Okay, we got New Zealand as some strength and CAD has some strength. So let's open up New Zealand and CAD. Here we go, New Zealand. Okay, I'm going to start with this one, New Zealand USD. I'm going to start from a higher time frame. Okay, massive mess here. Not getting anywhere. Forecasting for this, we're looking at overall longs actually. It's a range, and in fact, in 2017, my money would be all longs on this. Okay, that is my personal opinion on this. I would be all longs for this. Okay, the longs would be temporarily, because notice this piece right here. Excuse me 1 second. Maybe I'm allergic to New Zealand USD. Okay, so let's take a look at this. So, okay, now as we see this, and I'm saying longs on this right here, notice it's also shorts for these big boys right here. Now here's a question. When it comes to big boys and small boys, who wins? Okay, the big boys are always going to win. The big boys are always going to win. Now, thinking of that situation, if the big boys are going to win, you have to understand who is the big boy. Now, the big boy we're talking about is going to be somewhere above the weekly or the monthly charts, right? Which means they're not as active. They're not going to step in so quickly, so easily, okay? And if they're not going to step in so quickly or so easily, then what we need to see is it's going to take some time. We still have some more longs available in this. So when it comes to risk management, as if you ask traders, they're going to definitely say, yeah, buy this, go for it. If you ask billionaires, they would say, because we're in this area, too high risk. I'm not touching this at all. Okay, so there's two trains of thoughts. If you're coming in as an investor, don't touch it. If you're coming in as a trader and you got time available to you, there's longs coming in. Okay, and then shorts after that. Okay, but as an investor, there is no buy and hold or sell and hold. Sell and hold might get you some spikes, and buy and hold, this thing might crash as well. Okay, and if you do not have time to watch your charts over the months, then as an investor that will not work. Okay, but my money is on long for this as a trader. Okay, here we go. New Zealand CAD. Let's open up this one. Okay, New Zealand here is clearly strong. We have no issues here. Let's take a look at this on a higher chart. See what they're trying to do here. Okay, looking at longs on this one, and they're trying to spike out the top ranges. Okay, go back to the weekly. Okay, so for early 2017, expecting price in January or February to get back up to this zone here, or looking at this price at 96 to 96.50 area. In that zone, stop loss is well above 9,900. Take it up to 1,000 to be safer, actually, and then going for a massive short on this. This one would actually correlate a little bit with New Zealand USD, with the overall being a sell. Okay, so even though New Zealand is strong on the strength numbers, the charts are showing the strength is coming to an end. So be careful with that one. Okay, New Zealand yen so far, let's not mess with it. New Zealand, if it does get weaker, this range is going to react from here. So this is a pair we're not touching so far. Oh, sorry. I look like a kid in preschool just drawing all over the charts. Okay, here we go. Euro New Zealand weekly. Here we go. So on weekly here, looking at this as a sell still coming in. That means New Zealand is strong here. Higher time frames. We're still okay for the sell. We're still okay for the sell here. Yeah, so we're looking at further sells coming in. So New Zealand strength here and Euro weakness on this one. So in early 2017, January or mid-January, expect price to spike up a little bit, around 1.500 or 1.5050, where some sells might be ideal. And we're going down to as low as 4,400 with the potential of crossing 3,800. Okay, so aggressive on this one. Aggressive on this one. Okay, at the end of all this entire New Zealand group, I'm going to ask you guys a question on which one would be the best one to put your money on. Okay, so keep your eyes open on all these pairs, and it will come down to make a decision. Okay, Pound New Zealand. What will we say on Pound New Zealand? Okay, would you guys say the sells are still on for this? Or would you guys say we're in for the buys? Which one is it? The buys with the small boys or the sells with the big boys? Yeah, it's going to be sells with the big boys, won't it? So if you're looking at this and you're saying, okay, we're going to hit the sells from this. We're going to take it in from approximately 1.70. Sorry, what price is this? Okay, 1.7850 with a stop loss at 8,200. Now notice why I'm putting a stop loss up here and not just above the recent high here, because we're in a range right now. And ranges spike because there's an equilibrium of strength. If there is an equilibrium of strength, your spikes are going to go higher than your recent high. Okay? So stop losses above 8,200 with a potential target of 6,800 onwards. So that's going into early January and targets going into probably March. probably March or end February. Okay. Yeah, end February. Okay. All right, here we go. Aussie, New Zealand. Okay, let's go into Chris. I would say money spot. Yeah, that's good. That's good. Can see you've been studying the course well. Good stuff. Good stuff. Okay, here we go. Aussie, New Zealand. Sell mode here. Okay, sell mode coming in. They're working with a range. Now, if they're working with a range, what are we looking at? We're looking at both Aussie and New Zealand with strength. Okay? Remember how we were saying earlier, Aussie and yen, Aussie has some strength too, and then New Zealand was showing some strength across the board according to the strength numbers? Well, here it is. They're not getting anywhere. Okay, they're not getting anywhere. Let's take a look at this on the daily. Okay. Okay, the range says buy, but I'm... 1 second here. Give me a moment. I believe this is a sell. Yeah, this looks more like a sell. So let the prices get up to 1.0600. Your stop loss is going to have to be up in this area above 0.850 area. It's a high stop loss. Risk to reward is illogical. It makes it look like a more 1:1. So this is more for bigger capitals. If you're going to go for 1:1 ratios, something like that. Let me show you how it looks. Boom. Stop loss is in this range there, and profit zones are down in this area here. So we're looking at 1:1. So it's only worth it if you're going with higher amounts of capital. Okay, now we've done all pairs on the New Zealand group. Which pair is the best one? Which pair makes you say, oh, that one was a good one? It's more straightforward. There's less chaos in there. Okay, this chaos is built due to the uncertainty in the markets towards the last few months and going into the next few months. This uncertainty is fantastic. Okay, as more people flee the markets in terms of fear from the elections and this and that, I want all you traders to be more aggressive. This is the time to make money. Okay, this is the time to make money. It's a fantastic time to make money. Okay, I'm going to show you one of my trades. I'm in pound CAD. Okay, for a longer term trade on this, I'm going in for a short on this. Just before the webinar, I took a screenshot of my position that's running. Got just the standard lot running on this, not too much, and I'm currently running at pretty much a little over 1,000 pounds in profit for this one. For those of you who watched my last webinar, I was long on this earlier, up around a couple $1,000 on that one, a couple thousand pounds, sorry. That one came back at me. I ended up closing with like 52 pounds, so that one wasn't a happy day, but it's okay. The sells kicked in, and I had to take it in for the sells. So this was my buys were right around here, and then the sells eventually kicked in from here, and I had to get onto the sell side. So that one was pound CAD. All right. So with all this information, when it comes down to the way I did this correlation technique, okay, what we did was we went through all the similar pairs. We looked into what's going to happen. What we're doing is we're looking for the ideal currency pair. So I see one of you guys are saying Euro New Zealand is the ideal one. Let's open up Euro New Zealand. Yes. Euro New Zealand is pretty much the most cleanest one. So if there's a hold position for a pullback sell and hold, Euro New Zealand would be the ideal one. Okay, so as we wrap it up today, I also want to let you guys know on Tuesday, December 20th, I'm also holding a webinar at urbanforex.com. The webinar's topic is going to be trade picking. It's basically telling you, how do you pick the trade? There's so many pairs out there. How do you cherry pick the ones that are going to perform? So that one's over at Urban Forex. I can drop in the link for you guys in the chat. Let me copy this link for you guys. There we go. There we go. All right, so overall, when it comes to some of the pairs we looked at, Euro New Zealand is a hot one, and finally looking at not USD yen, looking at some buys. I'm looking at yen to be strong. So if you want to get in your travels and stuff like that, go to Japan now. Go to Japan now. The yen is weak. Make good advantage of it. Enjoy it till mid next year. Otherwise, after that, Japan is going to kick back into force. Okay? Hope you guys found this webinar useful, guys. Until next time, thanks a lot, FX Street, for having me here. I will see you guys in the next webinar or in the premium webinars. Of course, I go into more juicy details in the premium webinars at FX Street, so I look forward to seeing some of you guys in there as well. Thanks a lot, guys. Until next time. Cheers. Bye for now.
So in the aftermath of the US election, there's so many things going on, but the thing I want to focus on is the dollar. It's something that I've been concentrating on for a while, and I think some of the dynamics have changed seriously and very importantly. If you remember, the dollar's been trending higher for an extended period of time now. Much of it was driven originally by some of the change in central bank policy as the BOJ were easing and the Fed were looking at tightening. And that kind of moved in and sucked in market participants, and parts of the carry trade got caught in, emerging markets got caught out, and the oil price fell with it. After that phase, which finished in January this year, things have been very stable in the dollar since. But then as soon as the election result came, things turned around dramatically, and the dollar has been on an absolute tear. We've now broken the chart patterns. If you look at the chart of the DXY, you can see it's now broken that consolidation pattern and is now headed much higher. So this is now the next phase, and I think the accelerated phase of the trend higher in the dollar. We also have the same kind of breaks going on in the euro, which broke a consolidation pattern and is about to break a larger pattern here. And also things like dollar yen have started moving as well, finally in the direction that I've been hoping for some time, which is to see the dollar rising against the yen. The RMB has also been falling dramatically against the dollar, and all around the world currencies started shifting. The Asian currency index of ADXY, that's also starting to fall dramatically against the dollar. So what happened in the election that's changed things? Well, part of it was nothing's changed in the fact that that trend was there and we were kind of waiting for the next catalyst to bring it along. But the catalyst of Trump being elected was something that people don't really perceive why. Firstly, they look at rates and realize that rates backed up very sharply. And I think Julian Brigden's going to be talking about rates in this US election special. But that backup in rates obviously makes the US dollar more attractive. So US rates are much higher. It's a high yielding bond now versus virtually any other major currency. So that's an important thing. So that started to get people and traders involved. But there's a bigger picture backdrop, which is based on the election, which is the fact that Trump's policies are very clearly protectionist. This is one of the things I think he will likely try and push through, whether it's the breakup of TPP or some renegotiation of other trade deals. Now, the point being is the world is dollar starved. And if there's a shortage of offshore dollar funding, the Eurodollar market, and Trump starts protectionist policies, it means less dollars flow into the global system because they're doing less trade with the US. And that means there's just not enough dollars to go around for all those people who borrowed dollars. And so that in itself is an extremely positive outcome for the dollar, and something I don't think Trump realizes, because he's imagining that the protectionist policies will help US industry, but the problem is US earnings are going to fall because of it. In addition, exports are going to fall and imports will rise, which is kind of the opposite of what he was trying to do. But let's see how that plays out over time. And I'm not here to pass judgment on his policies. I'm here to talk about the market impacts of these things. So the dollar is rising because there's a perceived lack of dollars in the outside system. And we've seen this in the LIBOR market, which is the London Bank interbank offered rate. And that's been rising along with the risk of US interest rates rising. But the other reason it's been rising is because monies keep getting taken out of that offshore funding market and being put onshore in the US. So, for example, the money market fund change recently meant that money market funds who put their money in that Eurodollar market into the kind of secondary markets have now gone and put it in the Fed funds market. So that's taken about $1 trillion or so out of the traditional money markets. Okay, so that becomes concerning when you look at what the BIS have been talking about, which is this $10 trillion shortfall of dollars out there, where people have borrowed dollars, and as the dollar rises, they're scrambling to pay it back or secure new funding, but the funding costs are going up as well. So it's creating a real problem for people having to pile into dollars. Now, as the dollar starts to accelerate on these twin changes that have gone on, i.e. interest rate rise and the trade policies, it's going to suck in more people into that position where they're going to have to decide what to do with their shortage of dollars. Because don't forget, they've all borrowed dollars. And that Eurodollar market is them essentially borrowing dollars from the European banking system, the Japanese banking system, and elsewhere outside of the US banking system. And that's where there aren't enough dollars around. The other thing that's happened is, or is likely to happen, is there's going to be some sort of repatriation of corporate profits. Both Clinton was talking about this and Trump was. And I think they'll do it. I think it was Bush originally did it way back in the early 2000s. It was the Homeland Investment Act at the time. And the idea there is that corporations can bring back all of those profits, all that money they've hoarded offshore, bring into the US for a small tax penalty, and then that money can be implemented either in infrastructure or whatever other policies the governments are trying to do. Now, what's interesting there is you're bringing, obviously, if companies have holdings in foreign currencies, euros, whatever, they will sell those euros, buy dollars, bring them back, pay the small tax. So that automatically pushes the dollar up yet again. But the more important factor is not those guys with the foreign currencies, because most US corporations don't want to hold too much foreign currency because their earnings are in dollars and they're reporting dollars. It's people like Apple. They have hundreds of billions of dollars in US dollars cash, but in the European banking system. So what do they do with that? Well, they start to take it to the US banking system. And that again takes hundreds of billions of dollars out of that Eurodollar market. So there's more sucking out of that market. And all of these borrowers are going to be scrambling to find funding. It means that the Fed are going to end up having to extend swap lines all over the world to allow some dollar liquidity, but rates are going to go higher for this. It's going to get harder to borrow money, and that means that people are going to have to buy more and more dollars over time. Now, the thing about currencies is they trend for extended periods, and it's something I've talked about in Real Vision quite over the last 2 years now, is that the dollar has only moved up about 30% in this entire bull market. That's against 50% back in the late 90s and 100% in the early 80s. My target has always been that this bull market is going to be a very big one. And that's probably going to mean it's somewhere between 50% and 100%. So I think the rise from here is at least another 30%. Now, there are also knock-on ramifications for all of this. China, as you can see, is devaluing its currency rather rapidly. But we're going to find that currencies are going to start falling sharply. We're going to expose weak currencies. We've seen it in Egypt already. I think Turkey is going to get itself in a mess, and that's going to spread around the emerging markets. But also in that kind of protectionist world, countries like Korea and all the big exporting nations of Asia are going to get caught in the crosswinds. And, you know, I've been bearish on Korea for some time. It's not been the best bet. It worked last year, didn't work this year. But I think Korea and other countries like that, Taiwan, are going to struggle in this environment. They're going to struggle if the yen is weakening, which it is now. They're going to struggle if the RMB is weakening, and they're going to have to weaken their currencies themselves. And that's probably going to mean weaker stock markets as well, because global dollar earnings are going to fall. And we saw that there was a big feature of this year and last year is world trade is shrinking. So the globalization element of the world is definitely reversing, and the world is becoming slightly more insular. And that again means less world trade, less dollars in the system, and that makes it very complicated. So I think for me, the key thing from this Trump victory to focus on in markets is the dollar. I think it's a relatively easy, clean trade. It's moved very sharply recently, so I think the chance of a correction going into year end as people square up their books is relatively high. But at that point, I think 2017 is going to be another shockingly strong year for the dollar, and that will have macro implications beyond that. The law of unintended consequences will suggest that it's going to knock onto the US economy and the global economy overall. The overall bullishness in, for example, in oil prices is likely to be misguided. And I think we need to be very cautious about how 2017 plays out.
Gold, as we discussed last week as well, it has pierced through this level of support. So first of all, we broke down through 1140, 1,140 US dollars was the low, which you can see clearly here going back to October on the chart and also going back to March 2015. So we pierced that low yesterday. We closed just about above it. Now, today so far, we've broken down to 1,125 US dollars per ounce. So again, if you were going to short gold or silver, gold was the better market to short and take advantage of. Where are the next levels of major support? Okay, so the next major levels here are 1,116 US dollars. That would be another level which I would look out for. But I'm also looking for any evidence that we're going to get a spike low from the price action that we've had this morning as well. So I am keeping an eye. Look at 1 hour, 4 hour, just look to see if we get any sort of spike low and evidence that a low is getting put in place, because this time last year was the day after the FOMC statement that the low was put in, and then we rallied after that point. So I'm watching this very carefully today to see whether we'll see big buying around the current zones. Gold right now, it's broken down to 1,125 US dollars per ounce. If we continue this move lower, we could be in for a move all the way down to approximately 1,100. I mean, we're not too far away from it now. It's only a $30 move, 300-point move. It's certainly within the realm of possibility here. And if you're selling short, what you want to do is just continue to trail down your stop loss as you continue to take advantage of the selling pressure on this market. The US dollar has broken out to 14-year highs, but is it going to be a blow off top? It's very overbought, the US dollar. Is this just going to be a reaction to yesterday's Fed statement and the potential for 3 interest rate hikes next year? Or is this going to put in some sort of a top? Again, what happens today is important. Are we just going to see a faded rally here like we got with oil last week, where we saw, or on the open certainly, where we broke out to the upside and we've had a sell-off throughout most of this week? We want to just keep an eye on this candle today. Is it going to be a fake break to the upside? It looks good at the moment. It's still following through, but this could change if we see a big rejection candle forming to the close, or an indecision candle, or doji, which would be the price opening and closing at a similar level. Yes, that sort of shows us that the bulls are running out of steam here. Now, as we mentioned last week, yes, to a certain degree, the interest rate hike, a lot of that was priced into the dollar. What wasn't priced in was the Fed to come out with a statement that they would be looking for potentially going ahead with 3 interest rate hikes next year as opposed to 2. Hence the surge in the US dollar. How much follow through will we get is the big question. So gold right now, levels, we've got 1125 is the daily low, 1140 we've obviously breached below. Now we've had a break below that zone, and yes, absolutely, we closed and broke below the 1150 zone, which was also an important level for gold here. So right now it's looking quite weak. Certainly the bears are in control here at the moment, and you can see gold and silver, they're both trying to find a spike low, but they're not really getting there yet. We're not getting that big capitulation in this market yet that you would often look to get when you form a spike low. But then we'll be watching this very carefully tomorrow. So again, just going back to last year and the FOMC statement where we had a breakdown, and the following day, that was the low. That was the low we put in. We got a retracement the following day, consolidated throughout December, and then the big moves really happened in January. So watching this level, and it does have the markings of a V-shaped reversal pattern at the moment, but we'll see. We'll see whether this holds or not. So watching that carefully for that.
Okay, now let's really move to next week, the preview for next week's events, the week of Christmas. So, the week of December 19th to 23rd. First of all, we might have more Fed echoes, more analysis pieces over the weekend, analyzing the Fed from John Hilsenrath and co. So that could have more of an impact. But on Monday, we also have, at least here in the Eurozone, the German ifo business climate. That could be interesting for the euro. On Tuesday, we have focus on the Pacific side. We have the Australian fiscal outlook, meeting minutes. So big night for Australia. And the Bank of Japan's rate decision. No changes expected. Again, as we talked, the United States has more impact on the yen, dollar yen, than Japan. And for those trading the New Zealand dollar, we have the milk auction, which has been very, very positive of late. On Wednesday, next week, we have the crude oil inventories, as usual, every Wednesday, and GDP from New Zealand. Again, an important week for the Kiwi and in general for commodity currencies. And Thursday, that's the big day in terms of key events. We have the final GDP from the United States for the third quarter. It was more upbeat last time, 3.2, up from 2.9. Also, durable goods orders, which already feeds into Q4 investment, important for the Fed. For those trading Canadian dollar, we have retail sales and CPI double feature, and the Fed's favorite inflation figure, core PC price index, which has hardly moved in recent months at 1.7% year over year. On Friday, just before Christmas, we have the UK final GDP. Again, Canadian GDP and US new home sales. And on Friday especially, it's going to be the end of the week, just before Christmas. For many, it's a long weekend. Most places, it's a long weekend. So we might see these end-of-year moves. Will the dollar strengthen on these moves? I suspect it could weaken a bit, but we never know. Again, a lot depends on the Fed. Okay, so that's a preview for the week of December 19th to 23rd. All right.
It's about trying to anticipate what's going to happen in 2017. I'm Giuseppe Basile, also known as the Flip Stalker, and I will be your host in the next hour here till 9 a.m. EST, 2 p.m. GMT. Thanks for joining in. JM Anthony, there is Mauricio as well. So today I'm going to touch on how smart and dumb money is positioned in 2017. Smart and dumb money are the two group of players that I follow, and I think that they are very, very important when it comes to what could happen next in the major markets, particularly the market with high volume. Okay. I'm being asked to hold. Did they tell me when to go? So welcome back. I'm Giuseppe Basile, also known as the Flip Stalker. Thanks for joining in, and you're very welcome. Thanks to the FX Street team who has set up this event today. It's one day, one topic, and the topic today is trying to anticipate what's going to happen in 2017, how the major players are positioned or is supposed to be positioned in 2017. Particularly, I follow two group of, I attempt to model two group of traders, the smart money and the dumb money. And in my trading, risk management is my trader's job number one. So if you are watching the recording of this webinar, please stop it here and read the disclaimer here. The commentary, the trading ideas, and the chart provided in this webinar should not be relied upon as a substitute for extensive independent research. It should be performed before making your investment decisions. Okay, so the information I'm giving is merely provided for your general information. So I will not spend time on myself. I'll just remind you that I started FlipStalkerTrading.com in 2012, and I have a number of initiatives, including the FlipStalker Members Coaching Program. Now it's at its fifth session, which has started at the end of November. The next session is going to be February, March. And I recently started the FlipStalker Winning with Algos community, where I offer a free course on algos and how we can model algorithms and their effect on price. So if you're interested, you can go to FlipStalkerTrading.com and let's get into the content here. I present the charts and I offer my view on morning, Anthony, and welcome everyone. Thanks for joining in today. As I was saying before I actually offer my view on what I see and for 2017, I just want to briefly introduce the players and the beliefs that I have about these players in the market. So there are two players and two main players. Obviously, there are different groups within these players. And two groups. One is what I call smart money, and the other is dumb money. So smart money? Well, smart money is the group of people who know what they're doing, the large banks, professional traders, program trading, algorithms, and there are different families and types of flavors of algorithms. When I speak about algorithms, I don't speak about high frequency trading. I speak about algorithms like program trading, which actually participate on all time frames, including larger and smaller time frames. In fact, it is possible to observe this algorithm also down in the tick chart on the futures, for example, SP 500 E-mini futures, or the majors forex futures as well. So that money, on the other hand, I believe it's the traditional tech analysis crowd, the trend following people who use trend following systems. Also, the discretionary crowd, the people who believe that they can tame the market. And discretionary and typically these people do not have any stops or sometimes even an idea of stop. And of course, there's a group of people who believe, and these are all retail people who believe that trading is cool. Now, smart money or dump money by themselves do not win or lose all the times, but this is a strong belief I have. I believe that smart money initiates and leads market moves, while on the other hand, dump money obstacles price and follows market moves. So often it's either wrong or it's late, and so this is a very strong belief. And I believe that in order to win this game, we ought to stalk the market, the smart money, and that's the reason why you will see an assonance here between this and my nickname here. So again, smart money initiates and leads, dump money obstacles and follows. And if you want to learn more a little bit about how I model smart money, there is the winningwithalgos.com. You can go /start. You can get your free mini course on this material here. And I also offer a fixed trading signal service and have my coaching as well. So let's look at some of the markets here, and I will switch to my charts here. Give me a yes if you can see the charts. And I will start, as I mentioned, I will cover some major markets, and we will work really mainly here on the larger time frame. And as you know, as you can see here, I model dump money or part of the activity of dump money using moving averages. While to model smart money, I use a subset of Fibonacci retracement. So for now, we will keep the dump money out of the picture here, also because, as we mentioned, from the belief I provided before, dump money actually follows price and tends to obstacle price. But what actually drives the market, it's smart money. Now, this is the continuous contract of the SP 500, and for the way the continuous contract is calculated, sometimes what happens is that you actually keep looking at the chart as some of the level change, some of the past level change. So the last month is always aligned with the front contract, but there can be some change. So only for this specific market, I will also make reference to the SPY, which is the ETF that track the cash. Now, those who know my work know that the models that I use apply to the market if you go back to the 70s, and even if you go back basically to the to 1900, to the down futures. So the implication there is that algorithms have actually modeled or incorporated something which is actually fundamental about the market. If these models work also before computers were even invented. Okay, now I don't want to get into that. I have, if you look for material on FSU, you'll find a lot of that material. What I will say, and what is important to us, is the fact that in 2003, 2003 and again 2009. Once again in history, we actually tested a 50% retrace from zero. So from the very beginning of the inception of the equity market in US to the highs in 2000s, and this has happened a number of years, and it's still on today. So as you can see, and the reason why I'm using SPY, I explained that before, is because it does not shows the anomalies of the continuous contract, the way it is calculated by TradeStation here. But the only reason why I'm bringing this up is that I want to make you notice that this market has traded the 78 SPY level, and the low here on the SP 500 E-mini future was 667. You will remember probably in 2009 if you were trading. And what happened here is that this level has traded twice, been confirmed in 2009, and now it has reached the first target. It has reached the first target actually in 2013, okay? So in 2014, early 2014 here. And this target is the 1950 area, 1930 area in the SP 500 E-mini. So where is this market going, and where it is going to go? Very, very probably continue to go in 2017. Well, we have a second target above. Okay, that's where we have to look at, and that second target above is in the 2500 area, and for the SPY would be 252. For the SP 500, this is the level. 2500 is the level that I'm actually looking for, and this level might not be that far after all, given the way this market is moving. So my anticipation here, prediction, if we can use that term. I don't like using the term because we are not in the business of making predictions. We are in the business of managing risk when it comes to trading. And but if I'm asked to specify where this market might possibly go, well, 2500 is my target. In fact, I have a leveraged ETF position which will remove 2400 here, and that's where we see this market moving. This market is also, and this is also better visible on the SP on the future, and that's the reason why I use the futures, because the futures are really the truth when it comes to market, and I use them, and I'll show you also in the dollar index what's the implication in the dollar index and what the majority of people are seeing at the moment, and what we should be looking at as well. So thanks, Mauricio and Anthony there. So so as I mentioned, as this market went above that first target, it's now kind of in an extended mode, and the models I use work on mainly high volume market. For this index, I use the SP 500, and when we switch to the SP 500, I can show you this very same chart. And as I mentioned before, there is that anomaly that this low goes much lower here. In reality, that's only related to the way these contracts, the continuous contract is calculated. Okay, so you will see a lower level here, but when in 2009 this market was trading there, it was the low was 667. So this market is extended, and if you watch my analysis in FX Suite, we have modeled and captured, in October 2014, we captured this low here. A lot of people were worried, didn't know where the market was going, but the market was going to trace into next measure move here, 1770. And that area broke price into the first target and then caused, and then there was profit taking, a lateral move 2014, and another same anchor new high as traded here. And we captured this level before the fact. If you go back and watch my videos on FX Street or on my website, you'll see these levels traced well in advance. In fact, as you can see here, when we don't see where the market is coming back and we see highs, we can trace that high to high. And if the market gets back to that level, we know that there is a potential for participation. Okay, so there was a potential for participation, and it was clearly shown 4 times: end of August here, September, and beginning of 2016. So why I traced this measure move? Because this measure move, it's an inner measure move of that move that we saw on the weekly, and he has brought already price 2 weeks ago to the first target here. Now, as you can see, there is a higher second target which helps price into that 2500 that we mentioned before. So anticipation for 2017 is to see this price continuing higher in the coming weeks, whether in a very, very aggressive way or in a sequence of less aggressive move higher. First, getting it into 2394, 24. And secondly, there will be the 2500 larger target from the weekly time frame. And at that point, we will need to see whether this market will correct or will just continue higher like it happened back in the 90s. So this is one of the most dramatic and aggressive bull market in history here, and there's no indication that this market should actually reverse here. And there are a lot of people who are worried about this market, but remember always that the market claims a wall of worries, and the more people I hear speaking about a reversal, the happier I am being long here, because that happens all the time. People were worried here, people were worried here, people are worried at new highs, and the market claims a wall of worry, and there is also a lot of money on the sidelines, and when that money will come in the market, this market might go even much higher. In fact, some people project 3,500 for this market, believe it or not. Okay, so despite all the crisis and problems, there is really a lot of money which is out of the equity market. And that's not the time when we have to worry, when there are a lot of people who call, whistleblower who call for a reversal. Of course, anything can happen in the market. Okay, I'm not saying that could not happen, but before it happens in this current situation, and even in the most dramatic situation like in 2007, look at how much the market has retraced leisurely before starting a move lower, and the same thing happened in 2000s actually. So when we bring in the smart money here, we get even a rosier picture, because you can see that not only is the smart money supporting this price, but dump money is supporting this price too. And you can see it when the price gets into these areas. These are two simple moving EMAs, expansion moving average. One is 13, the red one, the other one is 26. Okay. If you have any questions, obviously, please shoot. Welcome, Costa. And okay, so there is no worry from that point of view. This market has to get below this to measure move here, and they have to turn as well. So I'm not saying that that's going to happen. I'm just saying that that didn't happen. If it has to happen, and will require months, if not years. As a lot of people are still worried about this market, I'm happy about it. So you have to be you have to have initiatives when people talk down the market. It's when the janitor and the taxi driver will be talking about the markets that we will need to worry. So to me, at this juncture, there's very little to worry about. Okay, if you have any questions on the equity, I'm going to close this first review here on the SP500, and I will move to the dollar index. Dollar index is very, very important. It has been the main. It has been on the news all the time in the last few months here, and this market was given for doomed. A lot of talks on the debt situation in US and whether that's solvable or not. I think that a lot of this down talking, it's really economic warfare. And the point is, I'm not saying that the situation in the US is rosy or it's going to be rosier with Trump, but we have to respect price and what price is telling us. Okay. Now, at the beginning of the second decade here, we saw this market, and again, I'm going to remove the dump money here because I want to focus only on what I see the smart money is doing in this market. Okay, so we had this lateral move. We have a partial range here. But actually, we're still pushing this price lower, as we can see. Price came into this area, and the bears, smart bears, say, no way, we don't want that. US dollar higher. Then the market came and kind of prompted and tested two more times this market. No way. Eventually, this market in end of 2014 here came above this level. This was the start of a dramatic move here, which is the first leg of what could be a 3 legs move. And currently, we are in the second leg. The second leg is typically known to be the longest as well. So if that's the case, you're going to see this market much, much higher. In fact, I'm going to tell you where I possibly this market. So once that lateral move here with a resistance above ended, and again, that resistance was smart money saying we don't see this market or want this market above this level. That lasted basically from mid 2011 to end of 2014, 3 years and a half. The market started a move higher, very, very steep here, and so it went into an extended mode. And as you can see, then smart money kept initially supporting this price at 94.30 for 6 tests: 1, 2, 3, 4, 5. These traces are not random; they are based on the models that are used to model smart money. However, at the beginning of 2016, I mentioned this break here. Something might be changing in the dollar, and at that point, I had the full retracement in mind here. Say, if smart money doesn't support that level, it's possible for this market to retest 89.80, and this was bothersome. What happened after that, though, is that in the next few weeks, the market started respecting again this level, and some of these people call this a reverse head and shoulder. To me, it is not a reverse head and shoulder. It is interpreting what algos are doing, as smart money is doing on very, very important levels. Okay, so once that started, I remember there was also an interview on FX Street, and someone asked, is a rate hike possible? What I mentioned is that if 94.50 is respected, this market can continue higher. And if this is respected, this would anticipate a rate hike. And in fact, the market just continued higher like a missiles here, and you know what happened after that. In December we had our rate hike, and that was anticipated by price here. The point is that I didn't know how the price would actually move higher. My only observation was that this level here was now respected. Okay, so and you can find that on FS Street as well. That's something I mentioned in one of the interviews. So the point I want to make here is not to say that I was right, or it's not about ego. It's about understanding where this market is going. That's much more important. Actually, that's the only important thing. Ego is definitely not important when it comes to trading. So the point is now we have smart money that will be watching this market at 106. 40. If you review the weekly show, you'll see that I mentioned this 106.30 a number of times, and that's where we are going. It's just a matter of understanding how we are getting there, meaning whether we will retrace or not, or just this market is going to pass into the level. But this could be a first level where smart money could actually take a stand and say, okay, what we are going to do with this market. Notice though that this is an extension. So with the facility with which this market will reach 105.20 could be followed by even easier continued move higher into 110.59. In fact, I believe that this market eventually will break above 113.03. And remember, the second leg, if this is indeed a second leg, and we will have a third one, it's not impossible to imagine the dollar index back to 130 here, which would mean that the euro would go back to 80.8. Okay. Now, is this going to happen? I'm not sure about it. What I believe is that we can anticipate. We cannot be sure of anything in trading, but we can anticipate that the 106 will trade in the first months of 2017, and then also the second target 110.60 and possibly 113.03. That breaking 113.03 will actually basically put this market back into the potential for 130 again. Okay, that would mean very low euro, difficulty for advantages or the difficulties for different countries. Certainly, Italy, Germany. So this is what we see in the dollar. So that means that all the majors, as also the minors, which trade against the dollar, will actually keep suffering as we move into 2017. Okay, so that's what I see for price: 106.30, 110.60, and eventually 113.03. We have the setup for that, and the market is respecting that setup. There's no reason to believe that this market is going to reverse out of the blue. Obviously, anything can happen. It can be a geopolitical event or anything, but that's the way smart money is positioned. And that money, which follows in obstacles, has been responsible for, in a way, intervening in this price in the 92 to the 94 area here, and actually kept pushing this price higher. Okay, and there's no participation at the moment, but obviously whatever retrace the dollar index will put on, or might put on, will be actually will be greeted with more longs or more buys from that money. Okay. Any questions so far? You can write them on the sure. So I have to finish at 8:45. That's perfectly okay, not a problem. So I'll be a little bit faster here. So when we look at silver, I like to use silver much more than gold to track the dollar and the effects of the dollar. This market has seen dramatic crisis here, and recently it came back to a previous area of support. The market moved higher, and also broke a sequence. Also broke a sequence here, but then it traded these shorts here, showing that there was indeed control by on the dollar, and this has the potential to push these prices much lower. If we look at the chart here and we extend it a little bit, we will see that this price can actually move much lower here. Let me change the see if we can see more price here. So there is a first target at 1090, believe it or not, and this market has been very technical in a sequence of measured movement. Now started moving in extensions. We had 50% retrace, we had another 50% retrace. So we actually framed this price in its move lower, and then the market showed an inner measure move on the daily. I'm not going to show this because we're on the weekly here, and they hit the first target, and now it's pushing well below that 1580, which was my target in the last trade, and that's where we're going to see short-term this market. And after that, this market could trade in extensions here. So I see at the beginning of the year this market going down to 1090, 11. That's not impossible if this market continues. But mind that below that there would be a second. There would be a second target here, and as aggressive that might seem, that's exactly the level where Buffett has bought around 5.70 for silver. So silver seems not to be affected by the news related to superconductors and all this. The technology that made a huge use of silver is gone. That was photography in the 70s, in the 60s, in the 70s. So, this whole idea that there's little supply. There's also little demand for this metal. So mind these two levels, 1090 and 580, are levels that we might see in 2017. Then I wanted to review some majors here, starting from the euro. I think it's important to understand what's going on here. So I think that there are a lot of people that believe that this might be right away continue lower. A lot of people are trapped in new lows here. And so let's quickly see what I can see here happening. And as you can see here, this market on the weekly recently showed a 50% retrace, which found participation on the day of the electoral vote here. And when we trace from highs to lows, we can see that area of participation, which broke price into first target and second target. And when you see profit taking from these levels, that shows to you that these models are real, that indeed there are agents and algorithms and professional traders who actually take profit at these levels. It happens all the time. I'll show you a brief example on user Japanese yen if we have time. Profit taking here, a lot of people got short here, right at the low, looking at a break of previous lows, and that's a big mistake because when you look at the break for previous low, you are very close to that second target. It's a little bit like when you trade any type of breakout or breakdown, you are very close to that first or second target, and that's the reason those techniques do not work well in modern markets. So what can we expect next? We can expect this market to continue in extensions, and in fact, very short term here, from lows to lows. The 106.20 is the level that this market could retrace to, and that will become short. Now, there is a second target on the weekly for this market. That second target brings this price in line with what we said for the dollar index, and believe it or not, second target, the first target was 109. The second target is going to be 093.48, which is the end of the euro, maybe. And I think we have only 2 minutes here, so Alinda, you can stop me anytime. And I wanted to review the US dollar, Japanese yen, and a couple of other, but there won't be time. I will only say that the US dollar, Japanese yen showed the 50% retrace 170, and there's targets above. And again, this is a line. So the first target is going to be 137.60. That's where we're going to see this market. So I hope this preview here was interesting, and if you want to know a little bit more about how I model the algos, you can go to winningwithalgos.com/start, and I hope this information is going to be useful for your trading 2017. And I took the chance to wish you a Merry Christmas and a happy holidays and a great new year, trading or non-trading year, to you and your loved ones. So thanks a lot for being here today, and I look forward to keep reviewing this market with you. Okay, so thank you very much, and thanks FX, Jordi, Costa, Mauricio, and Anthony, JM. Thanks for being here. Thanks, and Mauricio, for organizing the event. Thank you very much. Bye-bye now.
So I can say that the year of 2016 was indeed the year of shocks for the market, because there were many unexpected events. Most of these events were political events. I think that everyone is well acquainted with the list of these events, at least with some of them. surely we will mention the Brexit vote, which took place in June 2016. Opinion polls used to predict that British people will vote to remain in the European Union, but the opinion polls were wrong. And here we have now we are dealing with this Brexit talk and waiting for more clues on when exactly this would happen. But still, this is the course the UK has adopted. Also, there was a surprising victory of Donald Trump in the US presidential election, which took place in November. And also, once again, this is the case when opinion polls failed to predict the correct outcome of this event. There were also some stressful events in Brazil with an impeachment vote against the president, and also some tensions in Turkey as well. These events of political sort created high volatility in the forex market, and actually all hints show us that the same may continue in 2017, and next year we have to work with a kind of similar political reality. On the one hand, what we will see in 2017 will be formed by the consequences of the decisions the public has made in 2016. We will be dealing with Brexit for the United Kingdom, and this will be one of the major topics for those who trade the British pound. Donald Trump will surely have an impact around forex market in general, as it is a huge factor for the US dollar, and we'll speak about it a bit later. And also we see now that some political parties who are against integration, who want to their nations to be more independent, are now rising to power in European economies, in other countries, and this may form international policy, economic policy, and consequently have an impact on currencies, which are very dependent on such factors. So the first point is that 2017 is going to be as volatile and probably more volatile as 2016. We will have the continuation of this politically induced volatility. After we have spoken about 2016 a bit, we have spoken about the politics. I also would like to add that this year was very interesting in terms of central bank policy. As we know, central banks and their interest rates, their other policy measures represent one of the main drivers of forex market. And in 2016, we saw that many central banks have actually reached some limits of their monetary policy easing. I'm talking about the European Central Bank, the Bank of Japan, and probably even the Bank of England. The US Federal Reserve, as we have seen this week, has moved towards tightening monetary policy, and it is currently alone in this direction. But such central banks as the Bank of Japan and the ECB have also shown that they can't loosen their monetary policy forever. For example, the Bank of Japan had to use some other methods. Besides quantitative easing, the Bank of Japan had to work with long-term yields, and this represents a shift in the central bank's policy. There are many rumors that the Bank of Japan will have to taper its monetary easing next year, And as for the European Central Bank, it has announced a big quantitative easing program and was conducting this program in 2016. But we can see that by the end of the year, despite the fact that the ECB's President Draghi extended QE program, it also announced that beginning with April 2017, we'll have a less amount of monthly quantitative easing in the euro area. And this means that the European Central Bank also sees the end of asset purchases in future and understands that the bond market isn't that great for it to buy bonds every month with such great amounts. As a result of the fact that central banks have reached some limits in their loose monetary policy, and as their policy doesn't really provide great results, inflation is still very low in developed economies, below the target levels, and economic growth hasn't improved that much.
So in the aftermath of the US election, there's so many things going on, but the thing I want to focus on is the dollar. It's something that I've been concentrating on for a while, and I think some of the dynamics have changed seriously and very importantly. If you remember, the dollar's been trending higher for an extended period of time now. Much of it was driven originally by some of the change in central bank policy as the BOJ were easing and the Fed were looking at tightening. And that kind of moved in and sucked in market participants, and parts of the carry trade got caught in, emerging markets got caught out, and the oil price fell with it. After that phase, which finished in January this year, things have been very stable in the dollar since. But then as soon as the election result came, things turned around dramatically, and the dollar has been on an absolute tear. We've now broken the chart patterns. If you look at the chart of the DXY, you can see it's now broken that consolidation pattern and is now headed much higher. So this is now the next phase, and I think the accelerated phase of the trend higher in the dollar. We also have the same kind of breaks going on in the euro, which broke a consolidation pattern and is about to break a larger pattern here. And also things like dollar yen have started moving as well, finally in the direction that I've been hoping for some time, which is to see the dollar rising against the yen. The RMB has also been falling dramatically against the dollar, and all around the world currencies started shifting. The Asian currency index of ADXY, that's also starting to fall dramatically against the dollar. So what happened in the election that's changed things? Well, part of it was nothing's changed in the fact that that trend was there and we were kind of waiting for the next catalyst to bring it along. But the catalyst of Trump being elected was something that people don't really perceive why. Firstly, they look at rates and realize that rates backed up very sharply. And I think Julian Brigden's going to be talking about rates in this US election special. But that backup in rates obviously makes the US dollar more attractive. So US rates are much higher. It's a high yielding bond now versus virtually any other major currency. So that's an important thing. So that started to get people and traders involved. But there's a bigger picture backdrop, which is based on the election, which is the fact that Trump's policies are very clearly protectionist. This is one of the things I think he will likely try and push through, whether it's the breakup of TPP or some renegotiation of other trade deals. Now, the point being is the world is dollar starved. And if there's a shortage of offshore dollar funding, the Eurodollar market, and Trump starts protectionist policies, it means less dollars flow into the global system because they're doing less trade with the US. And that means there's just not enough dollars to go around for all those people who borrowed dollars. And so that in itself is an extremely positive outcome for the dollar, and something I don't think Trump realizes, because he's imagining that the protectionist policies will help US industry, but the problem is US earnings are going to fall because of it. In addition, exports are going to fall and imports will rise, which is kind of the opposite of what he was trying to do. But let's see how that plays out over time. And I'm not here to pass judgment on his policies. I'm here to talk about the market impacts of these things. So the dollar is rising because there's a perceived lack of dollars in the outside system. And we've seen this in the LIBOR market, which is the London Bank interbank offered rate. And that's been rising along with the risk of US interest rates rising. But the other reason it's been rising is because monies keep getting taken out of that offshore funding market and being put onshore in the US. So for example, the money market fund change recently meant that money market funds who put their money in that euro dollar market into the kind of secondary markets have now gone and put it in the Fed funds market. So that's taken about $1 trillion or so out of the traditional money markets. Okay, so that becomes concerning when you look at what the BIS have been talking about, which is this $10 trillion shortfall of dollars out there where people have borrowed dollars, and as the dollar rises, they're scrambling to pay it back or secure new funding, but the funding costs are going up as well. So it's creating a real problem for people having to pile into dollars. Now, as the dollar starts to accelerate on these twin changes that have gone on, i.e. interest rate rise and the trade policies, it's going to suck in more people into that position where they're going to have to decide what to do with their shortage of dollars. Because don't forget, they've all borrowed dollars. And that euro-dollar market is them essentially borrowing dollars from the European banking system, the Japanese banking system, and elsewhere outside of the US banking system. And that's where there aren't enough dollars around. The other thing that's happened is, or is likely to happen, is there's going to be some sort of repatriation of corporate profits. Both Clinton was talking about this and Trump was. And I think they'll do it. I think it was Bush originally did it way back in the early 2000s. It was the Homeland Investment Act at the time. And the idea there is that corporations can bring back all of those profits, all that money they've hoarded offshore, bring into the US for a small tax penalty. And then that money can be implemented either in infrastructure or whatever other policies the governments are trying to do. Now, what's interesting there is you're bringing, obviously, if companies have holdings in foreign currencies, euros, whatever, they will sell those euros, buy dollars, bring them back, pay the small tax. So that automatically pushes the dollar up yet again. But the more important factor is not those guys with the foreign currencies, because most US corporations don't want to hold too much foreign currency because their earnings are in dollars and they're reporting dollars. It's people like Apple. They have hundreds of billions of dollars in US dollars cash, but in the European banking system. So what do they do with that? Well, they start to take it to the US banking system, and that again takes hundreds of billions of dollars out of that eurodollar market. So there's more sucking out of that market, and all of these borrowers are going to be scrambling to find funding. It means that the Fed are going to end up having to extend swap lines all over the world to allow some dollar liquidity, but rates are going to go higher for this. It's going to get harder to borrow money, and that means that people are going to have to buy more and more dollars over time. Now, the thing about currencies is they trend for extended periods, and it's something I've talked about in Real Vision quite over the last 2 years now, is that the dollar has only moved up about 30% in this entire bull market. That's against 50% back in the late 90s and 100% in the early 80s. My target has always been that this bull market is going to be a very big one. And that's probably going to mean it's somewhere between 50% and 100%. So I think the rise from here is at least another 30%. Now, there are also knock-on ramifications for all of this. China, as you can see, is devaluing its currency rather rapidly. But we're going to find that currencies are going to start falling sharply. We're going to expose weak currencies. We've seen it in Egypt already. I think Turkey is going to get itself in a mess, and that's going to spread around the emerging markets. But also in that kind of protectionist world, countries like Korea and all the big exporting nations of Asia are going to get caught in the crosswinds. And, you know, I've been bearish on Korea for some time. It's not been the best bet. It worked last year, didn't work this year. But I think Korea and other countries like that, Taiwan, are going to struggle in this environment. They're going to struggle if the yen is weakening, which it is now. They're going to struggle if the RMB is weakening, and they're going to have to weaken their currencies themselves. And that's probably going to mean weaker stock markets as well, because global dollar earnings are going to fall. And we saw that there was a big feature of this year and last year is world trade is shrinking. So the globalization element of the world is definitely reversing, and the world is becoming slightly more insular. And that again means less world trade, less dollars in the system, and that makes it very complicated. So I think for me, the key thing from this Trump victory to focus on in markets is the dollar. I think it's a relatively easy, clean trade. It's moved very sharply recently, so I think the chance of a correction going into year end as people square up their books is relatively high. But at that point, I think 2017 is going to be another shockingly strong year for the dollar, and that will have macro implications beyond that. The law of unintended consequences will suggest that it's going to knock onto the US economy and the global economy overall. The overall bullishness in, for example, in oil prices is likely to be misguided. And I think we need to be very cautious about how 2017 plays out.
Today, well, I just want to practice something here, not waiting.
Sure.
Okay. It's the Great Depression. mental analysis to help us try and understand what may or may not come of the new year and further ahead, in fact. It's looking to me as clear as mud. There are many uncertainties, a lot of risks for financial markets. So let's get cracking. Harry, could we start by just talking a little bit about your background? And I think no better place to start than your new book.
Well, first of all, I'm called an economist, but I didn't start that way. I took economics in college, majored in it at first, then gave up. I thought it was kind of mostly useless what they were teaching, and nobody could understand it. So I studied business, went to Harvard Business School, came out, was a consultant to Fortune 100 companies for a few years at Bain & Company. But I like more innovative companies, so I started consulting to new ventures in California. And out of that learning there in business and cycles in business and studying the baby boomers for my new venture clients back in the early 80s, I started to see the importance of demographics in a wealthier world where the middle class mattered much more than it did, centuries ago. And so I came up basically with a whole new theory of economics, demographics, other key cycles that affect productivity and the geopolitical environment. And I've just been building those over years. My first book came out in 1989 when I started my newsletter then. I was largely lecturing to small business CEOs around the world through a company called Now Vistage. It was tech back then. And it was just a self-published book as a handout. And in that book, 1989 published, we predicted in the 90s, Japan would have a 12 to 14 year major crash and downfall, a long-term peak in their economy, while the US and Europe and the rest of the world would see the greatest boom in history, greater than the Roaring 20s. And my second book came out in 1993, right after the recession, which we also predicted would happen, and said, hey, man, Dow 10,000 by 2000, we're getting ready to hit that great boom after this recession. And that happened. And then next thing I know, I'm an economist and I'm lecturing to stockbrokers and financial advisors around the world. Now they don't like me so much because our latest books have been bullish because of the massive baby boom generation and the rise of new technologies like the internet and personal computing into the mainstream, much like autos and electricity and phones back in the early 1900s and roaring 20s. And but every boom ends. And so, obviously in the last decade, I've been warning about, hey, we've got a downturn coming. The baby boomers are done. The internet has peaked. Everybody's got the internet. And now we're down to Facebook with dancing dogs and cats and stuff, instead of breakthrough innovations like email and Google. So I've been bearish. Yeah, I came out with the Great Depression ahead in 2008, and books, the demographic cliff, I think was early 2014, showing that, hey, what happened in Japan then happened in the U.S. with a peak in demographics, and it's going to happen in more and more countries around the world, such that all this, quantitative easing and stimulus is fighting a tidal wave against it, and it will not succeed at a point, and I think it's already failing. So that's my history, and I just came out with this new book, The Sale of a Lifetime. We self-published it for our own newsletter subscribers, and it's coming out with my publisher in early January. And this is focusing more on bubbles, why we don't see bubbles, why they're clear as a bell, walk like a bubble, quack like a bubble, and people don't see them because they're on a high, they're getting something for nothing, but you can measure and predict bubbles. I hate the word black swans. There are no black swans. If something looks like a black swan and there's a cycle happening that you didn't see, and now it's turning the other way. So that's a brief introduction for me.
Okay, fantastic. Well, that will bring us to a recent Federal Reserve making interest rates. And we just had a pre-discussion before this live event. But Yohay, I mean, we saw that the market had been predicting this. A lot of it has been priced in. I'd like to now look at what the effects of that might be initially. Do you think there will be initial effects just from that very slight increase of rates, or do you think, for instance, Trump is going to be the next major catalyst?
I think Trump is the major unknown, the main catalyst. We don't really know what he's going to do, at least at the beginning. So, and he's one of the reasons. If he introduces fiscal stimulus, tax cuts, and infrastructure spending like markets believe now, and markets have gotten a bit ahead of themselves, then the Fed is going to raise rates even more. So, and if he's going to do less, the Fed is going to do less as well. So I think Trump is the main focus for the Fed. I don't see 3 rate hikes coming. I think 3 is the maximum. It's a cap. Sort of the upper limit. 2 seems more likely, perhaps the first one coming in June, after the first 100 days of the Trump administration, and the second one in December. But if the economy doesn't do so well because of Trump, or thanks to Trump, or regardless of Trump, and if the dollar is too strong, hitting emerging markets, and that would hit the US back, or dampening inflation, then another repeat of 2015 or 2016 with just 1 rate hike is also a scenario. So I see either 2 rate hikes as my baseline, 3 is if everything really goes well, and 1 is also a possibility if things go well.
Things there are corporate tax cuts, fiscal ease, trade policy. Okay, so bearing all those 3 things in mind, I mean, we can be skeptical of such a scenario as they factored into their dot plot of 3 hikes and this sort of aggressive turn towards increasing rates. I mean, the implementation of any of these policies, there's going to be a lag of infrastructure spending, and that can be considerable. So finding shovel-ready projects are going to be a challenge. So, I mean, there's going to be a huge delay in this, don't you think, Harry?
Yeah, there's a huge delay. Especially it takes forever for these things. My thing is that tax cuts won't work to expand capacity and jobs because corporations have already had free money courtesy of quantitative easing and 0 interest rates adjusted for inflation. And all they've done with that low-cost financing is buy back their own stocks and generate mergers and acquisitions. They're not expanding the pie because we already did that in the bubble boom. Companies overexpanded, overborrowed, consumers overbought and overborrowed, especially in housing. And now there's no way to expand, and this will just give the top 1% in companies more profits. I mean, more net profits after tax, but it's not going to expand the economy. So, another thing I tell people, this is my biggest argument, just simply demographics. Japan hit this demographic peak back in 1996 and has had quantitative easing nonstop escalating ever since. They're still growing at 0 on average with 0 productivity and near 0 inflation. You can't grow 3 to 4% as they're promising in a aging economy and society like we have in the U.S. and in Japan and Europe, and we're the best house in a bad neighborhood. So that's another reason this is not going to work. And also productivity. So workforce growth is going to be negative for the next several years. Population growth is going to be barely positive, 0.27%. That's near 0 for the next several decades. And workforce growth is going to be slightly negative for the next several decades. So the only way you can grow is productivity. We'd have to have 3 to 4% productivity. But guess what? Productivity has dropped like a rock in recent years. Because aging societies don't get more productive. Young people enter the workforce and get more productive. But after their late 40s, early 50s, people get less productive and they start dropping out of the workforce and retiring. So there's no way we can grow 3 to 4% growth sustainable. And who are you going to build infrastructures for? I'm getting older. You know how much I drive? A month, 300 to 400 miles now, sitting in downtown San Juan where I can walk almost everywhere. And I work out of my home. And someday I'll retire, probably not for a long time. But older people don't need more infrastructures. They don't need bigger houses. They pay down debt. They downsize their housing and infrastructures. So this is a fairy tale. And Republicans are proposing a Ronald Reagan strategy coming out of the inflationary demand insufficient economy in a time where we have excess demand. What we really need to do is reorganize debt and take these debt burdens off of our economy so we can grow to some degree in a slowing economy where there's going to be more retirees, less younger people, and there's no way to grow like this. So I think what's going to happen in 2017, all these promises have been made. And like Yohay said, to the degree he ups fiscal stimulus, now that monetary stimulus is not working, especially in Europe and Japan, going to extremes, the Fed's only going to have to offset them with higher rates. So I don't see how this happens. I think Trump got in from the dissatisfaction of the declining middle class and the all-star wrestling fans, I call them, who aren't doing well in this globalization economy, and globalization's peaking as well. And I think the economy is going to realize, and the market's going to realize sometime in 2017, this ain't going to happen. And they have priced in this 4% growth and only modest Fed hikes, and they're just going to be wrong about this, I think.
Yeah, I mean, on that point, I mean, talking about recessions, right? So, I mean, historically, that they come every, 4 to 7 years. The US is already in the fourth longest economic expansion in US history. You know, and by the time Trump is actually sworn in, I think it's actually going to be the third longest expansion. Yet we've got, the Dow coming up to the psychological level there. A lot of hysteria around Trump. Do you think this is going to blow up in everyone's faces, Yohay, next year?
Well, hopefully nothing will blow up too soon. But the factors that Harry mentioned are certainly worrying. The demographics, the retirement of the baby boomers, the exhaustion of ammunition by monetary policy. So in the US, one of the reasons for rate hikes is getting ready for the next recession, not having to raise rates too abruptly, and doing it that when we get the next recession, they can cut rates a bit. So, things are not moving too fast. I want to be optimistic. Optimism comes from maybe, in the US, hopefully Trump will not be so harsh on immigration, and demographics maybe could improve. I mean, there's contrast between campaign promises and what politicians actually do. And maybe a new wave of automation will come, but this will probably take more time for all those sci-fi movies to become reality, self-driving cars and things like that. So maybe another delay, maybe another extended pretend like they did with Greece will happen in the US for 2017. Maybe the falling off a cliff could be postponed, but we'll see.
Well, I mean, to me, you can't go from sort of ground zero where we've been at with sort of reckless. Initially the Fed had to do what they did, but QE2 never worked, and it's kind of reckless policy thereafter. But how can we go from that ground zero to all of a sudden pink clouds without anyone bearing any pain in between? Because that's what the market is looking like at the moment. When you look at these markets, you look at the dollar. The dollar's got a fundamental case for size because there's a huge shortage. It was BIS that came out recently and said that there's about $10 trillion shortage in the world. So and that's self-explanatory when rates start to go up and everyone's scrambling to cash in on that. So, but how can we go from ground zero to pink clouds all of a sudden and no one bearing any pain? It just doesn't make any sense to me. So, that's where I'm coming from. I'm not as optimistic as yourself there, Yohay. Or perhaps you were just saying you'd like to be, but it just
I'd like to think it will not happen. Maybe not in 2017, but either to get an improvement, as Harry mentioned, this global debt issue, also in the United States, all the deleveraging is still happening quite severely, at least here in Europe, that someone will have to pay the price with this big reset of debt. So, but I just think it won't happen in 2017. I think there will be another extended pretend.
Okay. So essentially, we're agreeing that we think rate rises are going to hurt borrowers. That eventually they're going to hurt the banks. And at the moment, the financials are doing really, really well. But I think the elephant in the room that people are missing is that if interest rates are on the rise and banks think that's a good thing for them when it comes to lending, well, guess what? You're going to have all these borrowers that actually can't afford anymore the repayments, whether it's on a bubble in the auto industry or the property market, and there could be a big fallout there. With inflation on the rise, and inflation is not a good thing. but central banks want inflation, but, why is that a good thing, Harry?
Well, it's not short term. They want inflation because they fear deflation more. Deflation is what you get in times like the Great Depression when, as Yohay was just saying, you're going through debt deleveraging, and debt deleveraging also causes financial asset bubbles like stocks and real estate and commodities to collapse because financial asset bubbles build every time you get debt bubbles. People don't realize that debt, just for example, in the United States, since 1983, total debt, government and private, has grown 2.6 times GDP for 26 years into 2008 before we hit a peak in the debt bubble. And since then, we've added more debt, especially in emerging countries, another 57 trillion to the world. I mean, we're in a time where debt's just out of control, and that's one of the big hurdles. Are you seeing my slides?
Yeah.
Okay. This is a graph that says, look, here's how much financial assets there are, bonds, loans, stocks in the world. And this is a dated graph from a study a couple of years ago. It's over 300 trillion, and that is more than 4 times the entire global GDP. And that's more than twice as high as it's ever been in any time in history. We've got a massive debt and financial asset bubble. And what happened in the 30s is a lot of those debts and financial assets deleveraged and disappeared, not for a cycle, not for a few years, and you go back to new highs. Stocks peaked in 1929 and didn't get back to those highs until 1953. 24 years later. Real estate went down, didn't get back to the highs for another 10 years, and in the bubbly cities like New York, it took 25 years. So we're getting ready to see a big reset. All of this quantitative easing, pushing money into the bank system, putting money free so people will at least speculate, and at least their home loans and car loans will go down, has only been staving off this debt deleveraging. Banks have not been forced to write down their loans, their zombie loans. Just keep them on the books and hope the economy gets better. And then when the economy gets better, you won't have to write them down 8 years from now. Not going to happen. Real estate is never coming back to the highs we've seen. It hasn't in Japan since its peak in 1991 on a perfect 42-year lag for peak home buying with their baby boom generation ahead of the rest of the world. Hasn't come back and is still on its bottom, down 67%. 25 years later. It's not coming back because there's more older people who are sellers, by the way, dying than younger people coming along and buying. And the young people, like the millennials here, don't feel as secure in a bad economy, and they've seen real estate go down. So this is the big thing that they're trying to prevent. And if I go back a couple slides real quick, my biggest innovation back in the late 80s, which allowed us to see the Japan crash and the boom in Europe and the United States, I just look at when new generations spend the most money, 46-year lag in the US, 47-year in Europe and Japan, and we get these generational waves, the blue background in this chart, which lets us see the economy almost 5 decades in advance. We predicted in the late 80s that Japan was going to collapse then. We predicted the US would hit its peak in 2007, and Europe a few years later in 2011, and that's when they started having their crisis after the U.S. subprime crisis. So demographic trends continue to work against the economy. In the U.S., we don't turn up again with the next generation till 2023. In most of Europe, there is not much of a millennial generation to bring the economy back. And guess who has the worst demographics of any country in the world after Japan? It looks just like Japan in the late 80s, Germany, who's supposed to hold up the EU. One more graph that's important. I have 4 major cycles that I've honed since my demographic cycle, the most powerful in the late 80s. A geopolitical cycle that's favorable for 17 to 18 years, and then not. And that started in 2001, 9/11. This cycle continues down until 2020. Then it starts to turn up. So we're going to see more of this terrorism, failed wars, civil wars, revolts against police brutality, revolts against the rich. And again, that's something Trump is playing on. 45-year innovation cycle. There's always innovation, but there's times when major clusters like cars, electricity, and phones together move into the mainstream and really change the productivity of workers and companies. And those like steamships peaked 1875, railroads 1920, automobiles 65, and the internet recently around 2010. And then those innovations are not as favorable. That's why we're sitting at zero productivity. That cycle has peaked as well. And then finally, we have every 10 years, a decennial cycle, stock markets see bigger crashes and recessions, and we're in such a down cycle. The point here of this graph, probably my most important graph, all four of the cycles I found that really matter, because there's an infinite number of cycles, all four point down at the same time into early 2020 before some of them start to turn up. So the next 3 years is the most dangerous since the early to mid 70s when we had our last major financial crisis, and before that, 1930 to 34, when we had the largest crisis in U.S. history. I think the next 3 years are going to be the worst anybody will see in their lifetime. And as I'm saying before, all of this massive, unprecedented, desperate quantitative easing, and now desperate fiscal stimulus, which can't work after you've overexpanded an economy, as I said earlier, is going to finally fail. And we're going to have this debt deleveraging. That's one reason I'm sitting in Puerto Rico. This is a bankrupt country, but they've been slowing for 10 years. They don't have civil unrest, and the weather's good here, and the people are pretty darn happy. I'm going to sit here and watch this fiasco from Puerto Rico the next year. I think the next 3 years is the worst we're going to see.
I'm in Spain also, 20% unemployment, and people still go out and smile and try to be positive, and the weather is great as well. So, sorry, Ross.
No, that's fine. So we're in a situation here. Are we in agreement that globalization is in decline as well? Because that really starts to make things complicated.
Hey, let me take them here real quick. I mean, this is something I've really dug into with this Trump thing and Brexit and the Italian vote. This is a global phenomenon. I track globalization all the way back to Christopher Columbus. There's somebody that did that analysis, thank God, as a percentage of global trade. It really surged for the first time with steamships in the mid to late 1800s and peaked with World War I. When World War I came along and then the Great Depression and World War II, of course, people didn't trust each other. The world was in turmoil, and global trade went from 40% of GDP, and they're double counting because they're counting imports and exports, but 40% to 10%. That's a massive decline, and it took 33 years. Well, we surged even stronger with jet travel and the internet and computing and all this stuff. I mean, and now we've had the greatest surge in globalization ever. And you know what people are saying? Hey, it was good in the 50s, 60s, 70s, and 80s, but you know what? More and more people are saying it doesn't work. It's favored Asia, it's favored Mexico, but we in Europe and US, we are sucking wind, especially the middle class and lower classes. And there is a revolt against globalization. I think it has peaked. I think this is going to slow down for decades before we realign the world economy around cultural, ethnic, financial, kind of natural groupings. I mean, Europe is extremely split from north to south and west to east in lifestyle and incomes and stuff. Even northern Italy is double the incomes or GDP per capita of southern. The United States has the red states versus the blue states. I'm telling you, the blue states are going to start leaving the United States with a Trump America, because basically the red states have taken over. So I think that globalization peak is another major factor, and it may be good in some ways for countries to pull back and protect themselves, but overall, it's a declining pie, and it's bad. And the Great Depression was marked by a tariff war, and now we have trade wars, and we're using quantitative easing to push down currencies and cheat. And now Trump is going to start probably a tariff war. So this is not a good sign.
So when you take that and then put it in the context of Trump's protectionist policies, when we've already got, as I mentioned there, the Basile coming out and saying $10 trillion shortfall in dollars out there in the offshore market. So with Trump's protectionist policies, that's going to mean less global trade and even less dollars in the offshore banking arena. So that is a case for a stronger dollar, is it not? But then coupled with our bearish outlook on the US economy and potential quantitative easing, whether that comes in, I mean, when do we think that could kick in? Could it kick in next year or further out?
In the US, I don't think it will kick in next year.
Go ahead, Yohay.
Sorry. I said in the US, I don't think more quantitative easing will kick in next year. I think the Fed will still on the path to raise rates, and things could go sour. Things could get much worse, as you described, but I don't think it will happen in 2017. Regarding Trump's trade wars, I think part of it is campaign rhetoric, and I don't think he'll implement everything he said. Okay, TPP was controversial anyway, and it didn't include a lot of tariff reduction, more related to intellectual property, environmental defense, things like that. So apart from TPP, I think, it's going to be more Republican pro-trade administration than isolation one. I mean, it's going to be somewhere in the middle, of course, nothing too extreme, but I think it'll lean more towards, I don't think it'll be that bad like we heard in the campaign. So I do agree that globalization is peaked. It's not only Brexit and Trump, it's also what we've seen in growth figures. The global growth exceeds the growth in trade, I think for the first time in 15 years this year, and that's of course telling that peak globalization is already reality, not just rhetoric. But I don't think we'll see a crash in globalization and total isolation of the United States, or I think there will be an effort to continue maintaining relatively high levels of trade, which will benefit everybody. Again, this is the optimistic view, at least for 2017.
Ross, here I have to disagree. I think there is going to be a sharp contraction in the economy. That only feeds greater isolation and separatist policies and protectionist policies. Again, exactly what happened in the Great Depression. And it only makes, everybody seems to benefit short term from protecting some jobs or protecting some industries, but everybody retaliates and the pie keeps getting smaller if you take away global trade from what's happening. And I mean, export industries are countries' most profitable industries, and that's what you're losing to protect your weaker industries. So it's not a good trade-off. Two things that are happening. You look at the last crisis in 2008 and 9, guess what rallied when everything went down at the worst of the crisis in the second half of 2008? U.S. Treasury bonds and also high-quality bonds in Europe, and the U.S. dollar. The U.S. dollar is the safe haven. We're not responsible fiscally or monetarily, but we're the best house in a bad neighborhood. We haven't done as much quantitative easing nearly as Japan, and we've done less than Europe, and we're not doing it now. Our demographics are not as weak, even though they're weakening dramatically, as Europe, and Europe's not as weak as Japan. And so we're the best house in a bad neighborhood, and with the reserve currency. We've been predicting the dollar's been trading at a trading range from 93 to 101 for 2 years, and it was going to break out. Well, it just broke out to 102 recently. Next target is 120. That means the euro goes to 0.85. That means the Australian dollar goes in the low 60s, which I've been predicting, both of those for a long time. The dollar is like tightening credit around the world because a lot of countries, especially emerging countries, borrow in U.S. dollars. The dollar goes up. The cost of those loans and paying them back goes up. That's a tightening impact. The other thing is we've been predicting that Treasury bond rates, even the best house in a bad neighborhood in the United States, would spike in the early stage of the next crisis, which is another reason I think this is happening, because the bond bubble trade would reverse. I mean, traders have been piling in, just betting on central banks continuing to do as they pledge and buy up their own sovereign bonds, and they just buy futures ahead of them, and you get a free lunch on leverage with low cost, with a near zero cost carry trade. This is the free lunch of all time. Well, no free lunch lasts forever. And now that late stage inflation is setting in, as we predicted, Trump is coming in and saying fiscal stimulus, build infrastructures, run deficits. Now bond rates are rising. They were already rising months before the election. They started to rise since, I think, early July. Trump accelerated that. We've been predicting the 10-year Treasury is going to go to 3% or a little bit higher. And if it breaks above that, where there's extremely strong long-term resistance, then we're really dead. But rising rates are not good for global borrowing, not good for mortgage loans and real estate, and certainly not good for stock valuations. In the early stage, they say, oh, they're rising because we're going to grow. That's not so bad. But stocks are valued at their projected earnings, which aren't so strong anymore, and discounted by the 10-year Treasury bond rate, say in the United States. The higher that rate, the less those earnings are worth in present day value, and stock valuations are not going to like rates at 3% or higher. And I think we're going to see that within months. So I think a rising dollar, rising sovereign bond rates, and this is happening in Europe as well, are going to be another trigger. The Italian default, which is just imminent at some point in coming months. I think you're going to have actually a dramatic downturn, and that is going to increase protectionism. I would agree with Yohay. If it weren't for all these kind of factors, yes, it would be natural. And yes, the Republican Party, the mainstream, is pro-trade, but Trump just kicked their ass with an anti-trade and protectionist policy and took over the damn party. So they're going to have a hard time fighting on this. Trump does want less trade and does want protectionism.
Yeah, I mean, the recent rise in the greenback and the spike an exodus from emerging markets. And as you said there, I think that's a trend that is likely to continue playing out in the coming year. It's just a question of, when we're getting into currency wars here, and the only way to win a currency war is by not being in one. And this thing's just going to self-implode, correct?
Yeah. I agree with that. But that's what everybody's doing. And actually, the United States is the only one that's not. That's why our dollar's been stronger. Japan now has their cumulative balance sheet, or quantitative easing, is 95% of their GDP. In Europe, it's 34%. And in the United States, I think it's 24 or 26%. Again, we're the best house in a bad neighborhood. But there is this currency war, and Japan is the one leading it. And despite being so aggressive, their economy keeps stalling, falling in and out of recession. They keep falling back towards zero inflation. And their productivity has been zero forever, as ours is going to be, and Europe's going to be in years ahead. It's a short-term solution to a long-term problem. Debt restructuring is the number one way to position an economy to grow again, even with weak demographics. Raising retirement ages is another way. We've aged 10 years longer on average for dying since we started all these entitlements programs in the Western world, and yet we're still retiring at the same age. People stay in the workforce longer, contribute more, and take less, and that's another way to fix this. But you're not going to get people to have more babies, especially in a risky time. So you have to restructure the bubbles in debt and financial assets that are only making the 1% richer and the everyday person fall behind, and are only creating bubbles that are going to burst even harder the longer you keep them up. So there is no easy way. There is no bridge over troubled water, but there's a more civilized way to do this. Rather than being in denial and just printing money and then going to fiscal stimulus, building stuff for nobody, which China's going to have the biggest bust in the world because they've been building stuff for nobody 10 times anybody ever has. Watch that for the next few years. When China goes, that's going to be the worst. But you can't have short-term solutions. You can't take more of a drug and expect things to work out well. That's what we're saying. And that's what governments are doing. Fix the problem. Deal with the debt. Restructure. Don't cut taxes. Raise taxes, especially in the more affluent, to balance budgets again, because you can't keep running deficits forever.
Okay, so we're in agreement that things are not looking good. There's nothing too positive out there. We're moving into a year when we have an awful lot of political risk ahead of us. We have the French presidential election. We also have the German parliamentary election. We also have a general election in the Netherlands. We've already agreed that there's a lot of populism coming around. What do you think could be the next major risk for 2017? Will it be the politics? Will it be interest rates going up? Could it be the default of an Italian bank or Deutsche Bank? What do we think, Yohay?
I think the focus has moved a bit away from central banks and into politics. French elections are the most important ones because there's a real chance that Marine Le Pen will become the French president. In the Netherlands, there will probably be some kind of a mainstream coalition. In Germany, I think that Merkel does have the upper hand, and that's only later up this year. French elections are the big unknown. And the second thing is, of course, what will Trump actually do? And I think that influences the Fed more than anything else. So I think we're going to be talking a lot more. I mean, in 2016, we already talked a lot more about politics, the run-up to Brexit, the implications, and then the run-up to the US elections and the implications. I think this trend of politics trumping central banks will continue. Central banks seem to be the only game in town, especially here in Europe, for quite some time, and I think now the ball sort of is in the politicians' hands worldwide, and these are risks. Of course, there's also other political risks, geopolitical risks. The war in Syria now tilts towards the regime, but I don't see an end coming to that, and that might still spill over to other places. In South Korea, they just impeached or suspended the president. There's going to be a new president over there, and the North Koreans would like to test South Korea when they have a new president. And with Trump, at least according to campaign rhetoric, sort of moving away from intervention, especially while talking about South Korea and Japan having to take care of themselves. So that could be also another risk. Things that are currently in the back burner, also Greece is in the back burner. Big risks, again, top risks for me. French presidential elections, the end of April, and Trump from January 20th, the inauguration, and, well, throughout the year, but especially his actions on day one and his first 100 days, sort of, that's what the media focuses on. So, and that's what moves markets as well.
Yeah, okay. And in terms of the banking crisis over in Italy and Europe, Harry, what's your take on that? How close do you think we could be to a global impact? I mean, if one of these banks goes down in Italy, or if Deutsche goes down, I mean, what is the effect of that? And is it really going to be something that's going to come to fruition soon, do you think?
Yeah, I do think so. And the stocks of these banks are reflecting it. I agree, with that the political environment's only going to get worse and more testy. But look, we've already seen Brexit. What do the markets do? Go up. Already seen Trump. Thought it was going to do that. Go up. We've just seen the Italian election. No, supposed to be bad. Goes up. So that's not going to kill the markets. The markets are on crack. They're on a high. They want to go up. There's nowhere for people's money to go. It's going to take something real, like a major bank going down. So that's what I put. I think China is the biggest risk and impact down the road because their bubble and overbuilding and real estate bubble is beyond anything in all of modern history. I've studied modern history in depth, but all you need is one big trigger, like the subprime crisis in the United States. People don't realize that was 4 states, California, Arizona, Nevada, Florida, most of that 4 states. And next thing you know, you got a worldwide stock collapse and recessions and banking and debt problems around the world. It was just a trigger for a debt crisis and a demographic crisis already in motion. So I think I've been saying the most likely trigger in the first half of 2017 is an Italian default or a Deutsche Bank default, and the whole thing about are we going to bail them out or not? Is Merkel going to bail them out? Is Germany going to bail out? And the Eurozone going to bail out Italy? And I think no, yeah, Merkel will probably have to bail out Deutsche Bank at some point, begrudgingly. And Italy will have to bail out their banks begrudgingly, but Italy doesn't have the power to do it. So I think when the markets see that, okay, that's what that's reality for the crack addict. Okay, you can't just keep taking more crack here. You can't. Quantitative easing isn't going to offset that sort of crisis. And even if they do start to ease again in Europe, United States, and elsewhere, they're going to be on a lag. In the European politicians, especially Merkel, are going to fight this at first. Nobody wants to set a precedent for bailouts for Deutsche Bank or Italy. And of course, Greece never has gotten out of its crisis, or Cyprus, and Portugal's right behind them, and Spain's right behind them. And like you say, Germany is growing against, bailing out. France is growing against the Eurozone. So is Italy. I mean, sooner or later, the euro is going to blow. I don't see any way around it. And I think in the United States, we got a different problem where I said earlier, I think major blue state blocks like the West Coast are going to say, we can't live in Trump America with these super conservative socialist policies and separatism and anti-trade and tariffs and stuff. Hey, Silicon Valley wants to trade with Asia, damn it. And I think they're going to have to break up. I think we could have some sort of civil breakup in the United States and stuff. So I think there's major stuff coming. All I keep warning, Ross, is that my long-term indicators, and of course increasing short-term indicators, say the next 3 years is likely to be the worst 3 years for the economy since 1930 to 33. That's what my indicators are telling me. and they're rarely wrong. They can be early or something, but they're rarely wrong. And they're, like I showed earlier, they're all pointing down. To me, there's no soft landing out of this. And the one country that has no chance of a soft landing at some point is China. They are so overbuilt. They don't need to build another anything, infrastructure, housing, offices, malls, railways, anything for the next 12 years, even if they continue to urbanize as fast as they're urbanizing. And people didn't notice, in 2015, for the first time, rural migrants into the cities there, illegal, unregistered rural migrants, actually went back home and reversed the trend. China's used to be building stuff for future people coming to cities. Now there's really nobody coming into cities, and their bubble's going to burst. So I do not have a good view at all, especially the next 3 years. And I think you get aftershocks for 3 years after that before some of the key demographics turn up again. So I think the next 3 to 6 years is going to be very difficult, period. I don't see any way around it. No bridge over troubled water.
Okay, Harry, so we've got a huge mosh pit there of negativity, which I totally understand where you're coming from.
I'm the most bullish guy on the block, so I'm not a bearish guy.
Yeah. So in that case, Harry, what are your thinkings on the dollar and gold? Okay,
the dollar's going to go up, I think, to at least 120. And again, that's enough to take the euro down in the 80s. I think the euro and the dollar long term should be at parity. Because I've traveled the world now for 40 years. The Australian dollar should be at 65 to 70 cents. The Canadian dollar ought to be at 75 cents roughly. All these things are out of kilter. So the dollar goes up and gold goes down. We got people out of gold and silver at the top of the silver market on the day, and we're not usually that good. But silver was testing the last bubble top in 1980, a real setup, and gold peaked a few months later. We got out and said gold's going to crash, especially when it breaks 1525, because it was in a long channel. And then when it hit 1,050, we said, hey, this is overdone. People are overly bearish. We're going to bounce towards 1,400, and then it's going to crash again. The dollar going up is bad for gold. Deflation instead of inflation is bad for gold. And gold's been going down since 2013 because that's when the Japanese really stepped up the QE wars and inflation fell anyway, and the gold bucks finally had to throw in the towel. They've been waiting for rising inflation and even hyperinflation, and you're not going to get it because the fundamental trend, debt deleveraging, financial asset bubble leveraging, destroying money and credit, which is deflationary. Gold correlates, whether you go back hundreds of years or the last decades, it correlates incredibly well with inflation. That's it. And it correlates with the 30-year commodity cycle that peaked between 2008 and 2011. Those are the two things it correlates. It's not a deflation hedge, and it's not even a crisis hedge, because our worst crisis that we've seen in a long time was 2008 and 9, and gold went running to mommy. It dropped 33%, and silver dropped 50% in the second half of 2008. It was the U.S. dollar and the highest quality sovereign and corporate bonds that were the safe haven. That's what I'm telling people to go now, wait this out, and when bubbles crash, then you can start buying commodities, and especially emerging markets will do well in the next boom. Developed countries are going to continue to slow for most, and we won't see a boom. The next global boom will not be like 1983 to 2007 for the developed countries, but it will be like that for emerging countries, especially the next big one, India. India has great demographics, is underinvested, under infrastructure. China is overinvested, overvalued, and their demographics have been declining since 2011. Declining, the only emerging country in the world, and everybody thinks China is going to take over the world like they thought Japan would in the late 80s, and they were wrong then. I think they're going to be wrong now.
Do you think China are waiting for a bottom in gold to buy more? Because they've been buying that up like hotcakes, putting on that hedge, versus the yields in the US dollar. Yohay, have you got any final words? Because we're going to start wrapping this up now. What's your outlook for 2017 and a little bit further into 2018? Just on a broad scale.
Well, 2018 is too far for me on my horizon. But I would say that we're going to see probably the current trends extend. That means a stronger dollar, at least at the beginning of the year, probably throughout the first quarter, maybe a bit in the second quarter. But then I think As I see it, markets have overreacted to Trump, and without the real fiscal stimulus, we're going to see the dollar retreat a bit, a natural correction. So I don't see our dollar reaching, at least not in 2017, the 80 level. I think we could challenge parity, though, at the beginning of the year. Europe, well, the euro is going to, I guess, will bounce afterwards, but will not go anywhere fast. UK is going to be a bit more in trouble after the official announcement of Brexit. Things might get worse. They're already beginning to get worse. So far, the UK skipped the worst of the Brexit. Regarding Japan, I think 115 to 125 is going to be the range. Japan will not like to have such a weak currency that will grab attention. Trump wants to, label China as a currency manipulator. Japan would not like to be under the radar as well. So I focus on currencies. So these are the main currencies. So I see a stronger dollar at the beginning of the year. And then it's too hard to predict with politics. I believe there will be some kind of correction, but there are really so many political factors. So let's talk again in June, I guess.
Okay, well, thank you very, very much, guys. We've got another panel of experts joining us very shortly. We're going to be talking about the markets on a more technical basis and less fundamentally. But Harry, thank you very much for joining us today. It was very, very insightful, and I will be getting you want to tell audience how we could get hold of your latest book?
Yeah. You go to the publisher's coming out with early January. We have books we've been using for our subscribers and marketing. You go to harrydent.com, and people in the United States or Canada can get a free book just for this shipping, advance of the publication. And we also have a free daily newsletter called Economy and Markets, which you can just put in your email and get on that for free and get to know us better. So that's the best way, harrydent.com.
Okay, there we have it, guys. Well, thank you very much. And Harry, I hope we'll have you again shortly. And Joseph, I'll see you in a few minutes for the next panel.
Thank you very much. It was fascinating. Thank you.
Thanks, guys. And have a good Christmas.
Okay.
Thank you. Bye-bye.
So I can say that the year of 2016 was indeed the year of shocks for the market, because there were many unexpected events. Most of these events were political events. I think that everyone is well acquainted with the list of these events, at least with some of them. Surely we will mention the Brexit vote, which took place in June 2016. Opinion polls used to predict that British people will vote to remain in the European Union, but the opinion polls were wrong. And here we have now we are dealing with this Brexit talk and waiting for more clues on when exactly this would happen. But still, this is the course the UK has adopted. Also, there was a surprising victory of Donald Trump in the US presidential election, which took place in November. And also, once again, this is the case when opinion polls failed to predict the correct outcome of this event. There were also some stressful events in Brazil with an impeachment vote against the president, and also some tensions in Turkey as well. These events of political sort created high volatility in the forex market, And actually, all hints show us that the same may continue in 2017. And next year, we have to work with a kind of similar political reality. On the one hand, what we will see in 2017 will be formed by the consequences of the decisions the public has made in 2016. We will be dealing with Brexit for the United Kingdom, and this will be one of the major topics for those who trade the British pound. Donald Trump will surely have an impact around Forex market in general, as it is a huge factor for the US dollar, and we'll speak about it a bit later. And also we see now that some political parties who are against integration, who want to their nations to be more independent, are now rising to power in European economies, in other countries, and this may form international policy, economic policy, and consequently have an impact on currencies, which are very dependent on such factors. So the first point is that 2017 is going to be as volatile and probably more volatile as 2016. We will have the continuation of this politically induced volatility. After we have spoken about 2016 a bit, we have spoken about the politics. I also would like to add that this year was very interesting in terms of central bank policy. As we know, central banks and their interest rates, their other policy measures represent one of the main drivers of Forex market. And in 2016, we saw that many central banks have actually reached some limits of their monetary policy easing. I'm talking about the European Central Bank, the Bank of Japan, and probably even the Bank of England. The US Federal Reserve, as we have seen this week, has moved towards tightening monetary policy, and it is currently alone in this direction. But such central banks as the Bank of Japan and the ECB have also shown that they can't loosen their monetary policy forever. For example, the Bank of Japan had to use some other methods. Besides quantitative easing, the Bank of Japan had to work with long-term yields, and this represents a shift in this central bank's policy. There are many rumors that the Bank of Japan will have to taper its monetary easing next year. And as for the European Central Bank, it has announced a big quantitative easing program and was conducting this program in 2016, but we can see that by the end of the year, despite the fact that the ECB's President Draghi extended QE program, it also announced that beginning with April 2017, we'll have less amounts of monthly quantitative easing in the euro area. And this means that the European Central Bank also sees the end of asset purchases in future and understands that the bond market isn't that great for it to buy bonds every month with such great amounts. As a result of the fact that central banks have reached some limits in their loose monetary policy, and as their policy doesn't really provide great results, inflation is still very low in developed economies, below the target levels, and economic growth hasn't improved that much.
Gold, as we discussed last week as well, it has pierced through this level of support. So first of all, we broke down through 1140, 1,140 US dollars was the low, which you can see clearly here going back to October on the chart and also going back to March 2015. So we pierced that low yesterday. We closed just about above it. Now, today so far, we've broken down to 1,125 US dollars per ounce. So again, if you were going to short gold or silver, gold was the better market to short and take advantage of. Where are the next levels of major support? Okay, so the next major levels here are 1,116 US dollars. That would be another level which I would look out for. But I'm also looking for any evidence that we're going to get a spike low from the price action that we've had this morning as well. So I am keeping an eye. Look at 1 hour, 4 hour, just look to see if we get any sort of spike low and evidence that a low is getting put in place, because this time last year was the day after the FOMC statement that the low was put in, and then we rallied after that point. So I'm watching this very carefully today to see whether we'll see big buying around the current zones. Gold right now, it's broken down to 1,125 US dollars per ounce. If we continue this move lower, we could be in for a move all the way down to approximately 1,100. I mean, we're not too far away from it now. It's only a $30 move, 300-point move. It's certainly within the realm of possibility here. And if you're selling short, what you want to do is just continue to trail down your stop loss as you continue to take advantage of the selling pressure on this market. The US dollar has broken out to 14-year highs, but is it going to be a blow off top? It's very overbought, the US dollar. Is this just going to be a reaction to yesterday's Fed statement and the potential for 3 interest rate hikes next year? Or is this going to put in some sort of a top? Again, what happens today is important. Are we just going to see a faded rally here like we got with oil last week, where we saw, or on the open certainly, where we broke out to the upside and we've had a sell-off throughout most of this week? We want to just keep an eye on this candle today. Is it going to be a fake break to the upside? It looks good at the moment. It's still following through, but this could change if we see a big rejection candle forming to the close, or an indecision candle, or doji, which would be the price opening and closing at a similar level. Yes, that sort of shows us that the bulls are running out of steam here. Now, as we mentioned last week, yes, to a certain degree, the interest rate hike, a lot of that was priced into the dollar. What wasn't priced in was the Fed to come out with a statement that they would be looking for potentially going ahead with 3 interest rate hikes next year as opposed to 2. Hence the surge in the US dollar. How much follow through will we get is the big question. So gold right now, levels, we've got 1125 is the daily low, 1140 we've obviously breached below. Now we've had a break below that zone, and yes, absolutely, we closed and broke below the 1150 zone, which was also an important level for gold here. So right now it's looking quite weak. Certainly the bears are in control here at the moment, and you can see gold and silver, they're both trying to find a spike low, but they're not really getting there yet. We're not getting that big capitulation in this market yet that you would often look to get when you form a spike low. But then we'll be watching this very carefully tomorrow. So again, just going back to last year and the FOMC statement where we had a breakdown, and the following day, that was the low. That was the low we put in. We got a retracement the following day, consolidated throughout December, and then the big moves really happened in January. So watching this level, and it does have the markings of a V-shaped reversal pattern at the moment, but we'll see. We'll see whether this holds or not. So watching that carefully for that.
Okay, so good morning, good afternoon, good evening, wherever you are. Okay, so good morning, good afternoon. Okay, good morning, good afternoon, and good evening, wherever you are in the world. This is Ross Burland here from FX Street, and I'm joined today by Wayne. Wayne, you've made a special arrangement to be with us this morning, so thank you very, very much. The idea is to give our audience today a feel for 2017, what to expect in the currencies. And Wayne, we're going to be talking more on a sort of a technical basis. So could I ask you to maybe just introduce yourself, a little bit about yourself, your background, and we'll get cracking.
Sure, yeah. I think a lot of people probably know me. I've been doing a lot with FX Street, I think, 11 years now? So I shouldn't be too much of a stranger. My background is I was a high-tech entrepreneur, got my way up to my dream job where I was a venture capitalist sitting at the top of a skyscraper in a beautiful office with 3 windows, view of the San Francisco Bay, doing what I thought I was meant to do, which was read business plans and listen to entrepreneurs give me pitches and bring in their prototypes, and I would decide whether my team should invest or not and raise money for them. I thought I was doing my perfect job. And then I read that there was this thing called the foreign exchange market, and it was a brand new thing you could trade on the internet. And at the time, it was $2 trillion a day. When I read that, I laughed because that's stupid. There's $2 trillion in the whole world. There's just no way there's that kind of money. Every day, $2 trillion. Turns out there was something to it. And so even though I just got promoted to vice president of the firm, we had 300 employees, I decided to quit. And I became a full-time foreign exchange trader. Now, I did trade on a demo account for a couple of years, but that's how I found Forex. And my very first trading account was simply a trading account, and then I had to spend $150 a month on charts.
Yeah.
So things have changed a little bit. It's been a while, but it's still, I think, the most interesting job in the world. Absolutely fabulous and fascinating all the time.
So you got into the FX market. Sort of what kind of era and year, and what were the conditions like? Is there anything comparable to now?
Actually, it's way better now because there's so many more market participants that the market's smoother. Okay. So I've been doing trade non-farm payrolls at FX Street for over 10 years now, and I remember some of the first ones where the release would come out, and the euro dollar, for example, would jump 300 pips in about 4 minutes.
Okay.
Then turn, drop, not just the full 300, but 150 below where we started. So, 300 up, 450 down, and then jump back up. Hundreds and hundreds of pips in a half an hour. And now non-farm payrolls, it pops 72 pips and stops, but it's because there are many, many more market participants. And obviously, if we went from 2 trillion to almost 6 trillion a day, there are more people involved. So therefore, I think it's actually better. As a retail currency trader, the markets are smoother, they're more predictable. And also simple things like, I think the pound dollar when I first started trading was like 9 pip spread. 9 pips was a normal thing, So the costs were a lot more back then, and of course too, just actually setting up trades was very difficult because
You'd have to open up a chart, do your analysis, and then go over to your trading platform and plug all the numbers in, sell at 1.3, what was that? 1.372, 1.372, and it was really slow and tedious. And there were always tons of mistakes. You would leave stops in the, in the orders and stuff like that. So sometimes you'd wake up and find out a stop has put you into the market. And you didn't mean to be in the market. You just forgot to take a stop out. And so it was rough and dirty, I guess, back then. It was difficult and much more expensive. So now it's much better. And plus now, like with FX Street, people have access to other experienced traders that can share what they're doing. Because when I started, honestly, there was no information, none, absolutely none. So I researched MACD for like 3 or 4 months, just trying to figure out what MACD was. Now you just log in FX Street, boom, there's 700 videos on MACD. Well, there wasn't anything like that back then.
There's so much information out there for traders. Back in the day, I guess you were calling up your broker to get all the information. And it's funny you mentioned there it was non-farm payrolls, but I mean, when I started in 2000, and I was working at a company called Subden UK, and I was on the market making desk, and I was a junior learning my way. And it was all about the trade balance. When the tick numbers came out for the US, that was the number. And we moved to an era now where it's all about job creation and so on. So, I mean, just keeping slightly away, if it's at all possible, from the fundamentals. So we've got 2017, and we've got the era of a strong dollar. Bearing in mind, of course, the entire market, and I think lying if you say otherwise, the entire market was positioned for real adversity with Trump coming in. Yet we got a complete reversal of that. So we're in an era of strong dollar. So let's just jump straight to it. What are your outlooks for the currency market in 2017, Wayne?
Well, like the dollar is a pretty simple one. If the central bank is in a policy and a continued policy of raising interest rates, then that typically will appreciate a currency. So if the Fed's going to raise interest rates, then it'll be strong. But what happened last year? They told us 4 rate hikes, and we got 1. So what happened is we learned very quickly that they were wrong, and they were backpedaling just within weeks of that December rate hike a year ago. And all of a sudden, the whole market collapsed because everyone was front running what we were told was going to happen, and all of a sudden, lots of people were on the wrong side of the trade. So the yen, for example, the yen pairs just got incredibly strong for a while, right? And then we went from 4 to 3, 3 to 2, 2 to 1. Well, we're facing 3 rate hikes, so they say. I'm a little surprised by that. I thought it'd be 2 this year. I was thinking June and December. Now they're saying 3. So, like, when are they going to do the 3? June, September, December? Or, because I think it would always be, and then there's also this idea of what if they backpedal again, right? So you got to be careful. And this is where technical analysis becomes incredibly important, because the only thing that could possibly change is the Fed's tone towards their policy over the year. But the actual fundamental data is not likely to change. The trends are going to stay in play. Jobs are going to be jobs. Inflation is going to be inflation. But it's really how the Fed changes their tone and changes their dot plot and stuff like that you can get on the wrong side of the trade. And technicals will tell you that. Right? Technicals will tell you that. And so, I recommend people use monthly pivot points to really identify the longer term, bigger supply and demand or support and resistance levels, and pay very close attention to price action. So if you get down into those key levels of support and resistance on the bigger charts, and then you see a price action change, nothing fundamentally would have changed in the economic data, but people are starting to get worried and they're taking money out of the market, and then you should pay attention to that technically.
Yeah. So let's look at the dollar yen, for instance, right? So we had this time period where we were down, balancing on the 100 level, that psychological level. That obviously is a pivotal point. Then we're up to the sort of region of 104. As we sort of got towards and we've taken off exponentially. And it was just the other day when I was doing the panel with Valeria, our head analyst at FX Street, and we were looking at this, and I raised the question, could we get to 120? And, we're sort of ticking up through 116, and, well, that might be a bit of an overshoot, but hey, I mean, what do you think, Wayne? I mean, we're not far from it.
Look, it totally could, right? It totally could. If the Fed's raising interest rates and Japan is not, then you totally could. That is a key psych level. People have it in their target. What I'm more interested in is, yes, we can hit that, but I think in the next 3 to 4 weeks, the Japanese yen is going to get very, very strong.
Okay.
Even though we bought the dollar yen and we've driven it all the way up, yeah, it could be 120. Okay, let's look at the pivot points in January. That'll show us the key, resistance levels. But I'm looking for some fund flows back into Japan. It could be today, it could be tomorrow, it could be the beginning of January, but it's coming soon, in my opinion. And so therefore, I'm really, really paying very close attention to pivot points, psych levels, and price action around those. So again, the technicals are going to tell me when the market starts taking profit.
Okay.
And that's usually the first or second week of January.
Right.
Because it comes down to, if let's say you're an American, you're a hedge fund or some sort of institutional investor, and you've shorted all the yen pairs, so you're long all the yen pairs right now. If you take profit today, you pay taxes in April of 2017. If you can just hang on 2 more weeks and get to January 1st or January 2nd, and then take your profit, then you pay April 2018.
Okay.
So now we're talking about fundamental analysis of financial flows, not economic data, financial flows and business cycles.
And that's key this time of year.
So I think it's coming. I think the yen is going to get strong, even though we all just shorted the yen. I'm sure everyone's been doing it. Last month was fantastic. This month was fantastic. It's all going to end very soon. And maybe not right now. Like, that's why you got to pay attention to the technicals, because it'll tell you when everyone else is doing it. I would never bet against the market, never in a million trillion years. But the market's going to tell me when it's happening, and I'm paying attention to that, like laser focused.
Okay, so just explain to me that then again. You're saying there's going to be a repatriation of yen back into the Japanese economy. Is that what you're?
Well, sort of. Okay, so there's two that are going to happen. I'm thinking more from an American point of view here. Big hedge funds, big institutional investors, longer term investors and such. That's what they're going to make decisions based on taxes. So they want to defer taxes. If they just made a lot of money since the election, which a lot of people have, you want to defer your taxation, right? So you want to take profit in January if possible. Now, if the market collapses, people are going to get out. Stops are already there. People are going to get out, but they would prefer to wait to January. Okay, so that's from an American point of view. The Japanese repatriation directly now, that's in April, and that is due to Japanese fiscal year end. So there's two different things, right? Sort of the American fiscal year end and then the Japanese fiscal year end. And so in April, I'm usually buying some Japanese yen again as well. And in between, if you will, sort of like in this February to March, April, I might be selling Japanese yen. But in January and March, April, I may be buying Japanese yen. It's a little complicated.
Yeah. Okay. No, I think we've got that. And then in terms of the risks for the Japanese yen, obviously we've got the proposed tax hikes from the BOJ next year.
Yeah.
So, I mean, historically, that's actually always tips the Japanese economy, which arguably is or is not already into recession.
Yeah.
But then when you've got
what kind of central banker does quantitative easing and then the government raises interest rates taxes? I mean, what a ridiculous concept. I don't know what they're doing. It's almost as bad as Draghi doing less for longer. I mean, what's the point of that? So I don't know, the ECB and the BOJ, I don't know what's going through the brains. I really don't. I don't get what kind of models
they're using. But look, a couple of years ago, Japan raised taxes, okay? And the Japanese yen in March, and I'm just going from memory, so I haven't prepared anything. I'm just going from memory. The Japanese yen got very, very, very strong because now Japanese businesses, Toyota, Honda, Fujitsu, Sony, they had to decide, do you want to pay cheaper taxes now or more expensive taxes later? And obviously they preferred the cheaper taxes. So the repatriation flows that particular year were greater and stronger than typical years. So if we're facing possible rate hikes and taxes in Japan this year, then, meaning 2017, then they're going to want to be taxed on the 2016 fiscal year, which ends at the end of March. So in that case, flow of Japanese yen strength, one in January and one in March. But again, it's only analysis. So that's like speculative fundamental analysis of financial flows. Doesn't mean it's going to happen. So that's why I need my technicals. I need my charts to tell me that those things are about to begin. And if I do see the reversals, then I put my trades in and put the stops in, manage it, and then let them run. And then I also know that they're going to come to an end. Once the financial flows are done, then the fundamental, like economic fundamentals take over again, and the Japanese yen should weaken. That's what you think. Because the fundamentals haven't, economic data hasn't created a strong yen. Financial data created the stronger yen, and those flows end.
Right.
So you got to just pick.
So if I'm reading you right, then so we're monitoring the fundamentals and we're looking at the charts for these pivotal moments, because I mean this consumption tax hike is planned for April, and I think it was the previous tax rate hikes of 1989, 97, and 2014. They all led to a recession in Japan. So we're looking for some Japanese yen strength, and then I mean, when do you think markets will start factoring economics and these consumption tax rate hikes? In March, would it be, or sooner?
We got to get through that normal financial flow first.
Right.
Okay. And let's just pretend the Bank of Japan is doing the right thing. I don't want to bet against them. Let's just pretend they're looking out for the best for their economy, and they're doing the best they possibly can based on their own politics and stuff. Great. Then I would want the Japanese yen to weaken. They would want the Japanese yen to weaken. That's the whole point, right? That's going to occur probably late August. I would say the third week of August. So that's so like January, I'm probably buying yen. March, I'm probably buying yen. Everything else, I'm basically neutral. Especially through the summer. And by the end of the summer, I'm probably rebuilding portfolios based on short yen.
Okay.
Right. And I tiptoe into those positions. It may take 6 or 7 weeks, maybe even longer, to slowly build up a yen position. So, for example, if I bought Kiwi yen, I got to move my stop to break even, and then I would buy Aussie yen, move my stop to break even, buy something else yen, move my stop to break even. And after the course of 6 or 7 or 8 weeks, maybe I can get 30 or 40 long-term positions in.
Okay, and then in terms of levels, so I mean we're 118 at the moment. That's a strong area. Plenty of offers above 118.50 by the looks of things. You're going to be buying into yen, but how far back do you think this has come? Because I mean we've had a huge upshoot, right? So usually markets like to replenish those spaces on the charts. Where do you think this could come back down to? And remember, we are in an era of strong dollar, fundamentally, right? Because there's a huge shortage on the offshore market of dollars, right? So we're in an environment where interest rates are going up and yields are going through the roof. So where do you think realistically the yen could get to?
Well, okay, so right now people are still buying yen pairs. Right? They still want to make money. They want to make money all the way to the end of the year. They want to take profit, really ideally in January. So these psychological levels are reachable. All right. And the only thing the technicals will tell you is that they finally are chickening out. Whether that means in December they need to cash out before a drop,
or it's in January. Okay, but it is coming because they want to take profit. So a big psychological level is a great catalyst for that to happen, because people can just say, I'm out, right? And especially if you're like a hedge fund trader or a banker somewhere, and you have a goal for the year. If you hit your goal so that you get your full bonus, you don't want to screw your bonus up, right? So if you've hit your target and your goals, right, you want to stop.
Yeah.
Because you don't want to mess that up, right? So whenever all these things happen, but we're talking about human nature now. We're not really talking about supply and demand of currencies on the short run, as far as when this is all. It's just human nature. So if they freak out in December, my charts will tell me. If they can hang on till January, then I'm going to expect the yen strength, and when I see it, I'm going to buy yen. But here's the thing, and you bring up a good point. Dollar's probably still going to be strong because the fundamentals haven't changed. Mm-hmm. So it all begins with profit taking. So if I'm long USD yen right now, I'm going to take profit when the market does its pullback, right? The first lower low, I'm out, right? And then if you want to speculate now, because the whole thing is profit taking, that's what happens, especially the big institutional investors. So when we see that coming, great. But we're also speculative traders, right? We want to make money today, income, not just wealth. So on the way down, let's say through January, as I'm selling yen pairs, I probably won't sell USD yen. USD yen will probably come down, but it's higher risk and lower reward. But I'd probably be happy to sell pound yen, euro yen without any problems, right? And if we're worried about Australia, that's going to happen next. And then Kiwi, you got to worry about Kiwi because of the higher yield differential. So, you got to pick and choose, find out what's weak at that point and sell. I mean, maybe it's Turkish lira again. I don't know. But I'll be buying lots of yen against anything weak, right?
And also, I mean, traditionally, when the yen is very, very weak, dollar yen struggles to continue because Japanese is a huge exporting nation. So the exporters cash in as soon as they can, on a nice weak yen. They want cheap yen. So that's something that can prevent the upside. Where would you like to move to next? Should we look at the euro? We've got a lot of political risks on the horizon.
I see that one actually is. I mean, we can always make it more complicated as we want, but the ECB, I'm a bit flabbergasted by their recent move of, let's do less for longer. I just don't get it, right? And then the other side of that is that there's just a problem with too many economies doing too many things independently, and the ECB only being able to deal with inflation.
Well, I've got something there. My take on the ECB was because of the political risks and the environment we're moving into, I imagine they're trying to put a buffer down for any downside volatility that could come of these elections. I mean, we've got the Germans, we've got the French, and the French is going to be probably the next biggest one because we've got this whole shift towards populism, and in an environment where globalism is shrinking, right? So there are huge downside risks for Europe. We've got a banking sector in crisis. There's many trigger points that should just go off, So I think the ECB are very, very nervous and they have every right to be so. And I think they wanted to taper. They always want to give us a mixed message, right? So I think they want to taper. They want the euro to remain weak, but they want that buffer, going out through this political season that we're moving into.
It sounds like mediocrity, right? It sounds like it's a compromise. And then it won't work. It just won't work. What they should have said, let's do more for longer, right? Let's get going. And then let's fix the banks. They still haven't fixed the banks. It's been 2007, 2008, 2009, 2010, 2011, 2012. I mean, when are they going to fix?
Their practices are even, sort of 10 times worse than they were before. I mean, you've got Deutsche Bank heavily indebted in derivatives, by, I don't know what the multiple is, but way more than the actual European economy in itself. So that's a huge trigger there. But on the levels, what are you looking at here? I mean, when I started the market, I remember we were in and out of euro dollars way below parity. I have to go right back to 2000. charts. But
but does the level even matter? So, like, for example, this year, 2016, the only level I cared about for the Euro USD was up there like 112, 113, 114, 115, in that area. I called it the Draghi no-fly zone. It seemed like when the euro got too strong, because it had nothing to do with euro, by the way, it was just too many people were long US dollar. Then they found out the Fed were changing their mind, so all of a sudden euro dollar would rise. Every week I would look at the commitment of traders report. No one was buying euro, but euro was up 500-600 pips. When it approached the 115 level, magically it would drop. And I suspect maybe it was the ECB doing it. Right. They would bring it back down. Now, so as an investor, let's say as a long-term investor, maybe you care about levels. Like, can the euro go to 80 cents? Well, sure, why not? But to me, it doesn't matter, because I'm looking at things hour by hour, day by day, week by week, and I will trade down into the pivot zones and take profit where I'm supposed to take profit. If I see changes in price action, I will adjust. So I'm looking at it as a trend that I may enter 300 times. It's not like I'm going to sell Euro USD and pray it goes to 80 or 75 or 92. I mean, who cares? Because there's going to be pullbacks along the way. So as long as we maintain a trend. So, for example, if it's a downtrend, I know it sounds simple, but if it's a downtrend, I'm going to sell rallies at resistance.
You're going to sell what?
I'm going to sell rallies at resistance.
Yeah.
Okay. I'll probably do 300 times, maybe 500 times, right? Like maybe 1,000. So like where it goes, it doesn't matter. What matters is when it stops. Right? Because I can't control where the market goes. That's central banks manipulate that, maybe big institutional investors manipulate that. I'm just not that big. Okay? But I can recognize when the trends come to the end and I need to full stop everything.
I mean, you raise a very good point there, because I mean, once you start, you've got to have your trading plan, right? And if your trading plan is, as you said, you're coming in and out, and you're following the trend. But if you've got this belief, this subconscious belief that the trend is down, but the market's going up, that's going to ruin your day, right? So,
well, it could ruin your year, right? So, this is where the technicals and fundamentals come into play. Just that's it. So you can analyze the fundamentals and say euro weakness, okay, genius, right? Dollar strength, genius, great. So sell it, right? But the technicals will tell you when you don't sell at support, for example. But amateur traders love to do it. They see a whole bunch of red candles and then they sell at support and they lose money. So that's why I say I sell rallies and I sell at resistance. But the other key thing is like when you hit solid profit zones. So in this case, I'm looking at big pivot points like, let's say, monthly S2, monthly support pivot. If we travel down to that area, I don't care what the price is. I really don't. It could be 82, it could be 101. It doesn't matter. If we hit that area and I start to see double bottoms and higher highs, I need to say, all right, nothing fundamentally has changed, but everything technically says my risk is increased exponentially. And the smart thing to do is to take profit and get out and wait for it to drift back up again and start all over. Right?
Go ahead. Sorry, continue. Sorry.
No. I was done.
What about the correlations? Because, we are going to, 2017 is going to be a year where we're going to be looking at everything across the board, whether it's oil, gold, the DXY, the yen. Have you got any favorite correlations that you would be looking at entering into 2017? What stands out to you to be the most critical?
The most critical is dairy prices. International dairy prices. No, honestly, if you watch dairy prices and correlate it with the New Zealand dollar, high correlation.
Right. Okay.
So that report comes out every 2 weeks. You can get prices on powdered lactose. I mean, you got to know your powdered lactose prices, right, to trade kiwi. But it's amazing. It's amazing information, and the Kiwi dollar jumps on this news. But like
most people should know this, gold can affect Australian dollar, oil should affect Canadian dollar. So I'm generally neutral on oil this year. So I'm going to be generally neutral on Canadian dollar, for example. Okay.
Well, why are you neutral on oil?
Well, first of all, I don't believe OPEC can do what they say they can do. So they signed a deal because they're all desperate. And that's the smart thing to do. Whatever it takes to get oil prices up. But one of the things I studied, I'm a student at Harvard, and one of the things we studied this last semester was game theory. And if you take a lot of independent people and you put them in a situation where they need to cooperate to achieve a common goal, and that's called a cartel. A cartel is set up in a way that everyone is actually incentivized to cheat, right? So if everyone raises oil prices, Venezuela is going to cheat. They're going to pump some oil and get the higher price.
Right.
Well, so are the Russians, and so are the Iranians, and so are the Iraqis, and all of a sudden everyone's going to cheat, in my humble opinion. And it has nothing to do with cultures and countries and all that kind of stuff. It's just right? Who's going to do it? So, like, first of all, the most famous cartel of all is the Medellin cartel, right? Pablo Escobar. He was the one in trouble. So, like, any cartel needs a hegemonic power, right? So it can be an international institution, right? But you have to have one powerful, superpower involved in the cartel. And then when it came to cocaine, it was Pablo Escobar. You'd sit down and have a meeting with him, and you put a gun in front of him. Let's talk, right? And with
Okay. All right. So so we've covered yen. We've looked a little bit there at the euro.
But you want to I can show you.
Please, yes.
I'm getting feedback. Did someone come in and turn the mic?
Say it again.
I'm getting feedback for some reason just now.
Okay.
Okay, there we go. So I can bring up an oil chart from this week, and I can show you what I planned on Monday.
Yeah, yes, please. Let's have a look.
All right, let's try this. Google and Microsoft always seem to not be able to deliver what they promise. Let's see here. Share. You tell me if you can see. I'll get you out of the way.
Yeah, perfect.
All right, so if I minimize this.
Yeah, minimize my ugly face out of there, please. Thank you.
Yeah, way better that way. Hang on. Okay, let's try this. I can't quite see. 1 second. Bear with me. And how's our time?
Don't be good for time. 15 minutes or so. And if there's anyone in the audience that want to fire any questions through, please feel free to do so.
So the webinar software. All right, here we go. I think I have it. Oh, it's on this one. Yeah, I have meetings with the central bank later. Kind of excited about that. So literally to the minute, I got a bull.
Right. Well, you head off when you need to head off.
Yeah, never met with the central bank before. I think they probably have halos and wings. All right, here we go. As much as I can get. All right. So can you guys see this?
Yes.
All right. Okay. Cool. I know this is a bit messy. I got some things on here. Maybe I'll clean it up. What I'm showing here, this is from a trade plan I did on Monday. Let me go back to last week to kind of give you a frame of reference. This is oil, by the way, WTI. Okay, let me get this. All right, so last week down here, the trade plan was to buy oil based on OPEC coming together and doing a deal. Why wouldn't they do a deal when Venezuela is about to go bankrupt and default, right? Iraq is in another war. Iran just got back online and desperately needs money. Russia is probably very close to going bankrupt as well. I mean, who doesn't need the money, right? They all need the money. So last week the idea was they're going to do a deal. The deal's going to move oil up. And then, of course, you want to look at Canadian dollar, right? So last week down in here, you see a weekly pivot.
Yep.
They move up, they move down, and they move up again. That's last week, but at the same time, I'm giving you the same speech I'm giving now. There's no way in a million years that OPEC is going to be able to fulfill the agreement.
Okay.
By the way, I'm getting that feedback again.
It's horrible.
I hear myself talking. But I'll keep going.
Try and block it out.
I'll keep going.
Put your finger in one ear and.
Yeah. Let's see this. Okay, so the whole idea, or I'm sorry, that was last time. These are monthly pivot points.
Okay.
So look at this. Over to the left, that was the target. That's the projected high. This is the projected low of last month. This is the projected high for this month. This is what I mean by using long-term monthly pivot points. Okay? So now here we are. Oil goes up. Look where we start. This is where we start this week. The monthly R2 is the top for the month of December. The projected top for the month of December. Look where we start this week. Down, up, double top. Now, keep in mind, I already am mentally bearish because I have my own analysis. I've made a decision, and I'm looking for technical analysis to tell me I'm a bear, right? So how about a double top at the exact projected top for the month? Not a bad thing, right? It makes a lower low, which is never bullish, and then retraces back into what I call a roll reversal zone. This old support has now become resistance. Okay? And then down, 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 up, up. Okay, along the way, you can see more roll reversals. There's another sell opportunity, down, 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 up. And to put all this together, on Monday, based on all of this the target was 52. Now it went to 51, so I have to apologize, but it went to 52. And the whole idea here, oops, that's not what I want to do. The whole idea here, right, so here it is. The whole idea is I've fundamentally made a decision. Now, if I'm wrong, I'm probably not going to get a setup because I'm wrong, fundamentally. But fundamentally, when I say, okay, I think oil will go up for a little bit because of an OPEC deal, but that there's no way the deal can work on the long run, then I'm looking for situations like this. Technically, a double top at the projected high for the month is a setup. That is a possible trade. The lower low sets up the next lower high. Sets up the next lower high. And you can see there's micro trades in here as well. If you really zoom in, you can see this on a smaller time frame, like a 15-minute chart, is simply a retracement back into that roll reversal here. Okay, and you can see I had that marked up with a yellow zone, which again is also a monthly pivot point. Lower low. So then I'm going to grab this. I'm going to take the old support. I'm going to look for resistance, and this is what this move was. It wasn't perfect. It's never perfect. Okay, and now you can see I'm cautious because we hit my target. And now it's moving sideways and up. So now it's no longer on the short run on this hourly chart, no longer bearish based on price action. But at the time, so on Monday, I'm begging for it to be bearish. I'm begging, right? I'm opening up my charts and I'm thinking, please turn bearish. Then I see a double top at the monthly R2, then a lower low, followed by a lower high, followed by a lower low. I mean, that's where the technicals fold right into the fundamentals. And having a combination, let's say a fundamental bias, having a bias, making a decision as a professional trader, that's where you make your money. Because a client comes to you and says, I need you to do the work. I need you to do the research. And I need you to make decisions for me and my money. And if you can do that, they're happy to pay you. It's not just sitting down and throwing a bunch of trades down and stuff like that. There's more to it. That where you make your money is where you make your decision. And the rest is just technical analysis, putting you in and out. But that's where I was on Monday, and I dropped the $4, which is, a pretty good week.
Very, very nice. And listen, I mean, your plan has got to be a good one in a strong dollar environment.
Yeah, I mean, it all comes together. I mean, that was a perfect storm, right? I mean, we could guess the Fed was going to raise interest rates. There was only a 98% chance, right? So that gets folded into it as well, right? So what I'm not control is, does it keep going? So if I'm a bear, let's say I just keep that for the whole year. Let's just say I'm just going to bet against OPEC. Let's say that's it. That was my big fundamental analysis. Well, then anytime I'm at resistance and I see weakness, then I sell. I don't have to buy and sell and up and down, long and short. I can just say, look, I'm anti-OPEC, not anti-OPEC. I just don't think they can fulfill the agreement. So I'm anti-OPEC agreement, let's say. And so anytime I'm at resistance and I see price action that shows weakness, then I sell. That's it.
So listen, you're pressed for time.
Very much so.
And I just want to leave you with this thought in terms of Trump. So this is something that made me chuckle yesterday.
Yeah.
What could go wrong?
Yeah, what could go wrong? Yeah. But it's interesting because, like Bank of Japan, I mean, that is such a question mark too. Most people just don't get as upset about them. They're not as, interesting as Trump, I guess. What the ECB is doing, and all these elections going on in Europe, it's a huge question mark there too. I mean, I think Trump is probably the least of our problems. Now, as I travel around the world, everyone's freaked out about Trump. Like I was in China, people want to know about Trump. I was in South Africa, people want to know about Trump. I'm just traveling. Everyone's like Trump. Sure, but we got some other problems as well to worry about. So really, what it comes down to is, what is it that you buy? And sometimes, there's plenty of things to sell, but what is it that you buy? And then, of course, putting all these other things together, because there's ebb and flows of strengths and weaknesses. And like I said, ebb and flow of are you doing fundamental analysis of economic data? Are you doing fundamental analysis of financial flows? I mean, all of this gets put together. But I think the most important thing for 2017 is that people trade having some thought, putting some thought into what their sort of marketable idea is. If you met a multimillionaire who could give you money to trade as a Forex trader, what intelligent thing would you say? What would your 2017 outlook be? Like, would you be buying dollar? Would you be selling yen? What would you do with the money? And anyone that just sits down and trades, just makes a bunch of trades, is never going to raise money from a professional investor. So you kind of have to look at it like, what is your point of view? And then back that up with the trading. What does the technicals, what does your trade history show? Do you have a history of selling euro all through 2016? And what is it that you're going to do? Are you going to continue to sell euro in 2017? And have logical, intelligent answers why that is your bias. And I think if people do that, then they know where they want to buy or sell, and they know when the trends have come to an end or when their trade plans have failed, which I think is even more important than knowing when you're right. It's knowing when you're wrong is, I think, most important, because you're managing your risk.
Well, you've made some excellent points there. Again, thank you very, very much for making that special time available for us today. That was very, very insightful. I hope our audience picked up some very good tips. We were talking about the pivot points, and and in this environment, not to second guess the market. We need to be looking at the technical charts to give us a lead in. So thank you very, very much, Wayne. It was a pleasure to meet you, and I hope to speak to you again.
Thank you very much. It was a pleasure.
Have a good day.
Thank you.